Welcome to your guide on passing the California-specific portion of the life insurance exam. In this video, we'll focus exclusively on what makes California different from other states. California Department of Insurance. First, you need to understand the structure of California's insurance regulatory system. At the top is the California Insurance Commissioner, who is an elected official, not appointed. This is crucial to remember. The commissioner serves a 4-year term and has broad authority to regulate the insurance industry, including the power to approve or disapprove rates, investigate complaints, and enforce the California Insurance Code. The California Department of Insurance, or CDI, operates under the commissioner's direction. The department's primary role is consumer protection. On your exam, expect questions about the CDI's responsibilities: licensing producers, examining insurers' financial conditions, investigating fraud, and ensuring compliance with California law. Remember, the CDI is here to protect consumers, not insurance companies or agents. California has some of the strongest consumer protection mandates in the nation. The department enforces these protections through regulations found in Title 10 of the California Code of Regulations. Keep this in mind. California's consumer-first approach shapes many of the unique requirements you'll see on your exam. California licensing requirements. Now let's talk about what you need to do to get licensed in California. As of January 1, 2026, you must complete 12 hours of pre-licensing education specifically on ethics and the California Insurance Code. This is separate from any general life insurance education. It's California-specific content, which is exactly what we're covering in this video. Here's something unique to California. You must undergo fingerprinting through live scan. This is California's electronic fingerprinting system connected to the Department of Justice. You'll receive a request code after submitting your license application, and you have 30 days to complete the live scan process. This is non-negotiable and specific to California's background check requirements. For your license application, you'll use either NIPR, the National Insurance Producer Registry, or CIRCON. The application fee is currently $88 for the examination, but always verify current fees as they can change. Once you're licensed, California requires renewal every 2 years. Miss your renewal deadline, and you'll face additional fees or even need to retake your exam. Mark your calendar. This is not a 3-year or 4-year renewal like some other states. For continuing education, California requires 24 hours every 2 years. And here's the California-specific part. 3 of those 24 hours must be in ethics and anti-fraud training. Within those 3 hours, at least 1 hour must focus specifically on anti-fraud. This is more stringent than many states, so remember the numbers: 24 total, 3 ethics, 1 anti-fraud. Producer licensing and appointment. Let's clarify some terminology that's critical for your exam. In California, insurers are categorized as domestic, foreign, or alien. A domestic insurer is incorporated in California. A foreign insurer is incorporated in another U.S. state, but doing business in California. An alien insurer is incorporated outside the United States, but operating in California. Don't confuse foreign with international. That's a common exam trick question. Every insurer must have a certificate of authority from the California Insurance Commissioner to transact insurance business in the state. Without this certificate, they cannot legally operate. This applies to domestic, foreign, and alien insurers alike. Once you're licensed, you must be appointed by an insurer to represent them. The appointment process in California involves the insurer submitting your information to the CDI. You cannot legally sell that company's products until your appointment is active. Check your appointments regularly. If an insurer terminates your appointment for cause, it goes on your record. California law recognizes both expressed authority and implied authority. Expressed authority is what's explicitly written in your contract with the insurer, what you're specifically allowed to do. Implied authority is what a reasonable person would assume you can do based on your position. For example, if you're appointed to sell life insurance, implied authority means you can provide quotes and explain policy features, even if your contract doesn't specifically mention those tasks. If you're a non-resident seeking a California license, California participates in reciprocity agreements. However, you must still meet California's specific requirements, including the 12-hour Ethics and Code Pre-licensing course. You cannot skip California's unique mandates just because you're licensed elsewhere. Non-residents must also complete the same 24-hour CE requirements as residents, including the California Ethics and Anti-Fraud component. California Ethics and Anti-Fraud Training. Let's zero in on anti-fraud training because California takes this seriously. Every CE renewal period, you need 3 hours of ethics, and within that, a minimum of 1 hour must cover insurance fraud prevention and detection. This 1-hour anti-fraud component became mandatory in recent years and reflects California's commitment to combating insurance fraud. California has specific definitions of unfair business practices that you must know. These include twisting, churning, misrepresentation, rebating, and defamation. While these exist in other states, California's penalties and enforcement are among the strictest. For example, twisting, inducing someone to drop one policy for another through misrepresentation, can result in license suspension, fines up to $50,000, and even criminal prosecution in severe cases. If you suspect insurance fraud, California law requires you to report it. You must report suspected fraud to the California Department of Insurance. The CDI has a dedicated fraud division, and failure to report known fraud can result in penalties against you as the licensee. The department provides online reporting tools and a fraud hotline. Remember, you have a duty to report. Penalties for fraud under the California Insurance Code are severe. Criminal penalties can include imprisonment, restitution, and fines. Administrative penalties include license revocation, suspension, and civil fines. California Insurance Code, Section 1871.4, allows penalties up to 3 times the amount of the fraud, plus up to $10,000 per violation. These numbers matter for your exam. California does not take insurance fraud lightly. Remember, this entire video lesson represents content that's unique to California. The 60-day grace period, the 12-hour pre-licensing requirement, live scan fingerprinting, and the specific anti-fraud training mandates, these are all California distinctions you must master for your exam. In the next section, we'll cover California-specific life insurance policy provisions, including grace periods and free look requirements that differ significantly from other states. Make sure you understand this foundational material before moving forward. Now we're moving into California-specific life insurance policy provisions. This is where California really stands apart from other states, and these differences show up heavily on your exam. Pay close attention to the specific numbers and timeframes. They're exam favorites. Grace period requirements. Let's start with one of the biggest California distinctions, the grace period. Under California Insurance Code, Section 10,113.71, life insurance policies must have a minimum 60-day grace period. I'll repeat that, 60 days. Most states require only 30 or 31 days, so if you're studying national materials, throw that number out when it comes to California. It's 60 days, period. Here's what you need to understand about how this grace period works. The 60 days does not run concurrently with the paid coverage period. What does that mean? It means if your premium was due on January 1st and you don't pay it, the grace period starts on January 1st, but your coverage from the previous premium payment extends through the end of that period, usually to the end of January. Then the 60-day grace period begins. The policy doesn't just continue for 60 days from January 1st. You get your full paid period plus the 60-day grace period. During the entire grace period, the policy remains in full force. If the insured dies during the grace period, the death benefit is paid. minus any unpaid premium. This is critical. Coverage doesn't lapse until after the grace period ends. The insurer cannot deny a claim just because the premium was late, as long as it's within the grace period. Now here's a California-specific notice requirement that trips up a lot of exam takers. The insurer must notify both the policyholder and any designated third party within 30 days of a missed premium. This 30-day notice requirement is in addition to the 60-day grace period. So the timeline looks like this. Premium is missed, insurer has 30 days to send notice, policyholder has 60 days from the due date to pay. The notice must include information about the grace period, the consequences of non-payment, and the policyholder's rights. Who is this designated third party? California allows policyholders to designate someone, maybe an adult child, a financial advisor, or a friend, to receive notices about missed premiums and potential lapses. This is especially important for elderly policyholders who might forget to pay premiums. The designation must be in writing, and the insurer must honor it. Free look period. Moving on to free look periods, which are another area where California provides extra consumer protection. For standard life insurance policies, California requires a minimum 10-day free look period. This starts from when the policy is delivered, not when it's issued. Delivery can be physical delivery or, with proper consent, electronic delivery. During this 10-day period, the policyholder can cancel for any reason and receive a full refund of all premiums paid. It's unconditional. But here's where California gets even more protective. For replacement policies, the free look period jumps to 30 days. A replacement policy is one that's intended to replace or substitute an existing policy. We'll cover replacement regulations in detail in Section 3, but for now, remember, replacement equals 30-day free look. This gives consumers more time to reconsider whether replacing their existing coverage was truly in their best interest. California also provides enhanced protection for senior citizens. Under California Insurance Code Section 10,127.9, if the policyholder is age 60 or older, they automatically get a 30-day minimum free look period on individual life and annuity contracts. Notice it says age 60 or older, not 65. This is a common exam question. They'll try to trick you with age 65, but California's enhanced senior protection kicks in at age 60. Let's be clear about what unconditional refund means. The policyholder can cancel for any reason or no reason at all. They don't have to provide justification. The insurer must refund all premiums paid without deduction for any policy costs or fees. If there's been any investment activity in a variable product, the refund reflects the account value, but for traditional life insurance, it's a full premium refund. Delivery requirements are specific in California. The policy must be physically delivered to the policyholder, or if electronic delivery is used, the policyholder must have given prior consent for electronic delivery. The free look period doesn't start until delivery is complete. If an agent fails to deliver the policy and just tells the client it's approved, that free look clock hasn't started ticking. On your exam, if they ask when the free look period begins, the answer is upon delivery, not upon issue or approval. Reinstatement provisions. Now, let's discuss reinstatement. If a policy lapses because premiums weren't paid, California allows reinstatement within 2 years from the date of default. That 2-year window is standard in most states, but remember, it's calculated from the date of default, the date when the grace period ended and the policy lapsed. To reinstate, the policyholder must provide evidence of insurability. This usually means answering health questions or undergoing a medical exam. The insurer can reject reinstatement if the insured is no longer insurable. However, the insurer cannot make reinstatement requirements more stringent than the original underwriting unless justified by the circumstances. The policyholder must also pay all outstanding indebtedness. This includes back premiums plus interest. If there were any policy loans outstanding when the policy lapsed, those must be addressed too. The interest rate on past due premiums is specified in the policy contract, typically between 5% and 8%, depending on when the policy was issued. Here's an important calculation point for your exam. The interest is calculated from each premium due date, not from the date of lapse. So if 3 monthly premiums were missed, each one accrues interest from its individual due date. The total amount owed for reinstatement is all missed premiums plus interest on each premium from its due date, plus any policy loan balance with its accrued interest, plus any other outstanding fees. Once reinstated, the policy goes back into force, but, and this is important, a new contestability period begins for statements made in the reinstatement application. If the insured lied about their health to get reinstated, the insurer can contest claims based on those misrepresentations for 2 years from reinstatement. The original incontestability period for the initial application still applies to those original statements. Incontestability. Speaking of contestability, let's cover California's incontestability provisions. California requires a 2-year incontestability period for life insurance policies. After the policy has been in force for 2 years from the date of issue, the insurer generally cannot contest the policy or deny claims based on misrepresentations in the application. The 2-year period is calculated from the date of issue, not from the date of application or delivery. This is important for exam questions about when the incontestability period expires. If a policy was issued on March 1, 2023, it becomes incontestable on March 1, 2025, regardless of when the application was signed or when the policy was delivered. However, California law recognizes specific exceptions to incontestability. Even after 2 years, an insurer can contest a policy if there was fraudulent misrepresentation with intent to deceive. This is a high bar. The insurer must prove not just that the insured made a false statement, but that they knew it was false and intended to deceive the insurer. Simple mistakes or forgotten information don't meet this standard. Another exception: if the insured's age or sex was misstated, the insurer can adjust the death benefit even after the incontestability period. They can't void the policy, but they can adjust the benefit to what the premium paid would have purchased at the correct age or for the correct sex. For example, if a male policyholder claimed to be female to get lower rates, the insurer can adjust the death benefit downward after 2 years, but they cannot deny the claim entirely. California also recognizes that certain policy provisions remain contestable even after 2 years. For instance, if a policy excludes death by suicide within the first 2 years, that exclusion operates independently of the incontestability clause. After 2 years, the suicide exclusion expires on its own timeline, but during the first 2 years, suicide deaths may result in only a return of premiums rather than the death benefit. Here's a California-specific application you should understand. The incontestability clause protects beneficiaries. Even if the insurer discovers a material misrepresentation after the insured's death, say, the insured failed to disclose a serious health condition, if the policy has been in force for more than 2 years, the beneficiary still receives the death benefit unless fraud can be proven. This is consumer protection at work. One more exam tip on incontestability. If a policy lapses and is then reinstated, a new 2-year incontestability period begins, but only for statements made in the reinstatement application. The original incontestability period for statements in the initial application continues to run based on the original issue date. So you can have 2 overlapping incontestability periods, one for the original application and one for the reinstatement application. Let's recap the critical California numbers you must memorize. 60-day grace period, 10-day standard free look, 30-day free look for replacements, and seniors age 60+, 2-year reinstatement window, and 2-year incontestability period. These numbers appear repeatedly on the California exam, and mixing them up will cost you points. In the next section, we'll dive deep into California's policy replacement regulations, which are some of the most detailed in the nation. These rules exist to prevent twisting and churning, and they're heavily tested on your exam. Welcome to this section on California policy replacement regulations. This section covers California Insurance Code, sections 10,509 through 10,509.9, and it's one of the most heavily tested areas on your exam. California has some of the strictest replacement regulations in the country, designed to prevent twisting and churning. Let's break down exactly what you need to know. Notice requirements for replacements. First, what is a replacement? A replacement occurs when a new policy is purchased and an existing policy is lapsed, forfeited, surrendered, or otherwise terminated. It also includes situations where existing policy values are used to purchase new coverage. Basically, if you're helping a client get rid of old coverage to buy new coverage, that's a replacement, and California's rules kick in. The cornerstone of California's replacement regulation is the Notice Regarding Replacement form. This is a mandatory document that must be provided to the applicant at the time of application or at the time of policy delivery, whichever comes first. The notice must be clear and conspicuous. It cannot be buried in fine print. It informs the consumer that they're replacing existing coverage and warns them to carefully consider whether the replacement is in their best interest. As the agent, you have specific responsibilities when a replacement is involved. First, you must submit a copy of the Notice Regarding Replacement form with the application to the replacing insurer. Second, you must leave a copy with the applicant. Third, you must list all existing policies being replaced, including the insurer names and policy numbers. If you fail to disclose that a replacement is occurring, you're violating California law, and penalties can include license suspension or revocation. Here's where it gets interesting. There are responsibilities for both the replacing insurer and the existing insurer. The replacing insurer, the company issuing the new policy, must verify that the agent provided the required notice. They must also maintain records of all replacements and make them available for examination by the insurance commissioner. Within 3 business days of receiving the application, the replacing insurer must send written notification to the existing insurer that their policy is being replaced. This gives the existing insurer a chance to contact the policyholder and attempt conservation. The existing insurer, the company losing the business, has rights too. Once notified of a replacement, they have a limited window to contact the policyholder and present reasons why the existing policy might be better than the proposed replacement. This is called a conservation effort, and we'll discuss it more in a moment. The key point is that California's system creates checks and balances to ensure replacements are legitimate and in the consumer's best interest. Replacement documentation. California requires extensive documentation for any replacement transaction. Let's go through each required document. First is the policy summary. This is a brief description of the proposed policy's features, benefits, and costs. It must be written in plain language. No insurance jargon that confuses consumers. The policy summary must include the death benefit, premium amount, cash value accumulation, policy loans provisions, and any riders or additional benefits. It must also disclose all fees and charges. The agent must provide this at the time of application. Next is the ledger statement, also called an illustration or projection. This shows year-by-year values of the proposed policy, typically for 10 or 20 years. It must include guaranteed values and, if applicable, non-guaranteed values based on current assumptions. The ledger statement helps the consumer see how the policy will perform over time. For replacements, California often requires side-by-side comparisons, showing the existing policy's projected values versus the new policy's projected values. This transparency prevents agents from making unrealistic promises about the new policy's performance. The contract summary is similar to the policy summary, but more detailed. It must include all policy provisions, exclusions, limitations, and renewal or termination conditions. Think of it as the Cliff Notes version of the full policy contract. It must be provided before or at policy delivery. Now, about those conservation efforts by the existing insurer. When the existing insurer receives notice that their policy is being replaced, they can reach out to the policyholder within a reasonable time frame, typically 20 to 30 days. They might send letters, make phone calls, or even have an agent visit the policyholder. The goal is to explain why the existing coverage might still be valuable. Maybe the existing policy has lower costs, better riders, or accumulated cash value that would be lost in a replacement. Conservation efforts are legitimate and encouraged under California law, as long as they're truthful and not coercive. However, the existing insurer cannot harass the policyholder or make false statements about the replacement policy. 30-day free look for replacements. Here's a critical California distinction we touched on earlier. Replacement policies automatically receive a 30-day free look period. Not 10 days, 30 days. This mandatory extension gives consumers extra time to reconsider their decision after comparing the old and new policies. The 30-day period is unconditional. The policyholder can cancel for any reason and receive a full refund. The refund must be processed within 30 days of the cancellation request. There are no penalties, fees, or deductions, except for variable products, which I'll explain in a moment. The notice about the 30-day free look must be attached to or printed on the policy itself. It cannot be a separate document that might get lost. The notice must be conspicuous, often in bold or larger font, and must clearly state, "You have 30 days from the date you receive this policy to return it for a full refund." This is a replacement policy. You should carefully consider whether this replacement is in your best interest. For variable life insurance or variable annuities, the refund provisions are slightly different. Because these products have separate accounts with fluctuating values, the refund is based on the account value at the time of cancellation, not the premium paid. If the account value has increased, great, the policyholder gets the higher amount. If it has decreased due to market performance, the policyholder receives the lower account value. However, many California insurers voluntarily provide a premium refund guarantee even for variable products during the free look period to avoid disputes. The 30-day free look for replacements applies to all ages. Remember from Section 2 that seniors age 60 and older automatically get a 30-day free look on individual life and annuity contracts regardless of whether it's a replacement. So for seniors, the 30-day free look applies doubly. Once because they're a senior, and again if it's a replacement. Replacement register. California requires replacing insurers to maintain a replacement register. This is a detailed log of every replacement transaction. The register must be maintained for at least 3 years and must be available for inspection by the California Department of Insurance at any time. What goes in the replacement register? Each entry must include the policyholder's name, the agent's name and license number, the date of the replacement, the name and policy number of the existing insurer and policy being replaced, and the new policy number. Essentially, it's a complete paper trail of every replacement. Here's an important detail. The register must be cross-indexed by agent and by existing insurer. Why? So the Department of Insurance can quickly identify patterns. If one agent is doing an unusually high number of replacements, that's a red flag for potential churning. If one insurer is losing an unusually high number of policies to replacements, the department might investigate whether another company is engaging in predatory replacement practices. The evidence requirements for compliance are strict. The replacing insurer must retain copies of all notices, policy summaries, ledger statements, and signed acknowledgments from the applicant. If the department audits the insurer and finds missing documentation, the insurer faces fines and penalties. As an agent, you should keep your own records of replacements as well, because if a complaint arises, you'll need to prove you followed all procedures. Prohibited replacement practices. Now, let's talk about what you cannot do during a replacement transaction. California law prohibits several specific practices, and violating these can result in immediate license suspension. First and most important, you cannot make materially inaccurate presentations or comparisons. What does materially inaccurate mean? It means any statement or comparison that would influence a reasonable person's decision and is false or misleading. For example, If you tell a client that their existing policy will lapse in 5 years when it's actually guaranteed for life, that's materially inaccurate. Or if you compare the new policy's non-guaranteed projected values to the existing policy's guaranteed values without disclosing that the comparison isn't apples to apples, that's materially inaccurate. You cannot cherry-pick numbers to make the new policy look better. All comparisons must be fair, balanced, and based on comparable assumptions. If you're comparing two whole life policies, use the same dividend scales or interest assumptions for both. If you're comparing a term policy to a permanent policy, you must clearly disclose the fundamental differences in coverage duration and cash value accumulation. California provides special protections for seniors age 65 and older when it comes to annuity replacements. If you're recommending that a senior replace an existing annuity, you must have a reasonable basis for believing the replacement is suitable. This means analyzing the senior's financial situation, needs, and objectives. You cannot recommend a replacement just to earn a new commission. That's churning, and it's illegal. For seniors, California requires additional scrutiny. If the senior is over 65 and the annuity being replaced has surrender charges or is in its accumulation phase, you must document why the replacement makes sense despite those penalties. Maybe the new annuity has significantly better benefits, lower fees, or features that better match the senior's needs. But you need to document your reasoning. Undocumented senior annuity replacements are a major enforcement priority for the California Department of Insurance. Misrepresentation in replacement transactions is grounds for immediate license revocation. Misrepresentation includes lying about the existing policy's features, exaggerating the new policy's benefits, failing to disclose surrender charges or penalties, or claiming the replacement is required by law when it's not. It also includes forging the policyholder's signature on replacement documents, which unfortunately happens and results in criminal prosecution. Here's a real-world example of a prohibited practice. An agent tells a client that their 20-year-old whole life policy is outdated and no longer competitive, and recommends replacing it with a new policy. The agent fails to mention that the old policy has guaranteed dividends, low policy loan rates, and significant cash value, while the new policy has higher fees and no such guarantees. That's a materially inaccurate presentation because the agent omitted critical information. If the client complains, the agent will face disciplinary action. Another common violation: replacing term insurance with term insurance repeatedly, every few years, just to generate new commissions. This is called churning. Each time the insured replaces their term policy, they're older and the premiums are higher. The agent benefits from new commissions while the client pays more and more. California prohibits this practice, and agents caught churning face license revocation and restitution orders. Let's recap this section's essentials. Always provide the notice regarding replacement form. Ensure all documentation is accurate and complete. Remember the 30-day free look for replacements. Maintain proper records for at least 3 years, and never make materially inaccurate comparisons or misrepresentations. Seniors age 65 and older receive enhanced protections, especially for annuity replacements. California's replacement regulations exist for one reason: to protect consumers from unethical agents who put their own commissions ahead of their clients' best interests. On your exam, questions about replacements will test whether you understand the documentation requirements, the timeframes, and the prohibited practices. Study this section carefully. It's worth a significant portion of your California-specific exam content. In the next section, we'll cover California-specific disclosure and notice requirements, including buyer's guides, notices to designated third parties, and the enhanced protections California provides for senior citizens. Welcome to this section on California-specific disclosure and notice requirements. California requires more consumer disclosures than almost any other state, and these requirements are designed to ensure that policyholders, especially vulnerable populations like seniors, have all the information they need to make informed decisions. Let's dive into what you must know for your exam. Buyer's Guide Requirements. Under California Insurance Code, Section 10509.975, insurers must provide a buyer's guide to every life insurance applicant. The buyer's guide is an educational document that explains in plain language how life insurance works, the different types of policies available, and how to compare policies from different companies. The timing of delivery is critical for your exam. The buyer's guide must be delivered at the time of application or before, not at policy delivery. Why? Because consumers need this information before they decide to purchase, not after they've already committed. If an agent delivers the buyer's guide at the same time as the policy, that's too late. It's a violation. The content of California's buyer's guide is standardized and must include several key elements. First, it must explain the difference between term life insurance and permanent life insurance. Second, it must describe how cash values accumulate in permanent policies and how policy loans work. Third, it must provide guidance on determining how much life insurance coverage a person needs. Fourth, it must explain the importance of comparing costs between different policies and insurers. Finally, it must include information about the free look period and the policyholder's right to cancel. Here's an important exception you need to remember. If the insurer provides a 10-day unconditional refund period, meaning a free look period of at least 10 days, the buyer's guide requirement may be satisfied by delivering it with the policy instead of at application. However, most insurers choose to deliver it at application anyway to avoid any compliance issues. On your exam, if they ask about an exception to the buyer's guide delivery timing, look for the 10-day unconditional refund provision. California also requires that the buyer's guide be written in plain language. It cannot be filled with technical jargon or insurance industry terms that confuse consumers. The Department of Insurance reviews and approves buyer's guide content to ensure it meets readability standards. If you're using a buyer's guide, make sure it's the current California-approved version. Outdated guides don't satisfy the requirement. One more point about buyer's guides: they're separate from policy summaries and illustrations. The buyer's guide is educational and generic, explaining life insurance in general. The policy summary is specific to the proposed policy. Both documents serve different purposes, and both are required in California. Notice to designated third parties. California recognizes that some policyholders, particularly elderly individuals or those with cognitive challenges, might benefit from having someone else receive notices about their policies. That's why California law grants policyholders the right to designate a third party to receive notices. Who can be designated? Anyone the policyholder chooses: an adult child, a spouse, a financial advisor, a trusted friend, or even a professional fiduciary. The designation must be made in writing, typically on a form provided by the insurer. The policyholder can change or revoke the designation at any time, also in writing. Once a third party is designated, the insurer must send duplicate notices to both the policyholder and the designated third party. This includes premium due notices and lapse notices. The idea is that if the policyholder forgets to pay a premium or misses a notice, the designated third party can step in and ensure the policy doesn't lapse unintentionally. Let's talk about premium due notices specifically. Remember from Section 2 that California requires insurers to notify policyholders within 30 days of a missed premium. If a third party has been designated, that notice must also go to the third party within the same 30-day time frame. The notice must clearly state the amount due, the due date, the grace period expiration date, and the consequences of non-payment, specifically that the policy will lapse if payment isn't received. Lapse notices work the same way. If a policy is approaching lapse at the end of the grace period, the insurer must notify both the policyholder and the designated third party. The lapse notice must explain that the policy will terminate, what happens to any cash value, and whether reinstatement is possible. This dual notification system helps prevent accidental lapses, especially for seniors who might not be managing their finances as closely as they once did. California has also embraced electronic notices, but with important safeguards. The policyholder and the designated third party must provide affirmative consent to receive notices electronically. Consent cannot be buried in fine print or assumed. It must be a clear, separate agreement that explains what notices will be sent electronically and how to revoke consent. If electronic notice is used, it must be delivered in a way that ensures receipt. Email is acceptable if the recipient confirms receipt or if the insurer receives a delivery confirmation. Posting notices on a website and expecting the policyholder to check regularly is not sufficient unless the insurer also sends an email or text notification that a new notice is available. California requires actual notice, not just availability of information. Here's an exam tip. If a question asks whether an insurer satisfied its notice requirement by mailing a letter to the policyholder but not to the designated third party, the answer is no. Both must receive notice. If a question asks whether electronic notice without prior consent is acceptable, the answer is no. Consent is mandatory. Senior Citizen Protections. California provides enhanced protections for senior citizens, and these protections are heavily tested on your exam. Let's start with the age thresholds, because mixing these up will cost you points. Different protections kick in at different ages, so pay attention. For senior citizens age 60 and older, California Insurance Code Section 10,127.9 mandates a 30-day minimum free look period on individual life insurance and annuity contracts. We covered this in Section 2, but let me reinforce it. Age 60 is the threshold for the enhanced free look. Not 62, not 65, it's 60. This applies to all life and annuity policies sold to individuals age 60 or older, regardless of whether it's a replacement or a new purchase. The 30-day free look for seniors must be clearly disclosed in a special notice attached to the policy. This notice cannot be buried in the policy contract. It must be a separate, conspicuous attachment, often on colored paper or in a distinct format. The notice must state in plain language: you are age 60 or older. California law gives you 30 days from the date you receive this policy to return it for a full refund of all premiums paid. You may cancel for any reason. Now let's talk about seniors age 65 and older because they receive additional protections beyond the 30-day free look. California Insurance Code Section 10,127.10 focuses specifically on annuity transactions involving seniors age 65 and older. When selling an annuity to someone in this age group, the agent and insurer must ensure the transaction is suitable. What does suitability mean in California? It means the annuity must be appropriate for the senior's financial situation, needs, and objectives. The agent must gather information about the senior's income, assets, liquid net worth, tax status, and financial goals. The agent must also determine whether the senior can afford to have money tied up in an annuity, especially if there are surrender charges. If the senior needs liquidity and the annuity has a 10-year surrender period, that's probably not suitable. California requires agents to complete a suitability form for every annuity sale to a senior age 65 or older. This form documents the information gathered and explains why the annuity is appropriate. The form must be signed by the agent and the applicant. A copy goes to the insurer, and the insurer's home office must review and approve the transaction before the policy is issued. This home office review is a safeguard against unsuitable sales. If the insurer's home office determines the annuity is not suitable, they must decline the application or contact the senior to verify the information and ensure the sale is appropriate. Insurers cannot just rubber stamp annuity applications for seniors. They have a duty to protect these consumers. Prohibited practices specific to senior sales include several red flags that California regulators watch for closely. First, recommending an annuity with a long surrender period to a senior who may need access to the funds. Second, recommending that a senior replace an existing annuity when the replacement doesn't provide a clear benefit, especially if the existing annuity has surrender charges. Third, using high-pressure sales tactics, such as telling a senior they must decide immediately or the opportunity will be lost. Fourth, misrepresenting the annuity as a simple savings account or CD equivalent when it's actually a complex insurance product with restrictions. California also prohibits cold calling seniors to sell annuities. Agents cannot randomly call seniors and pitch annuity products. There must be a pre-existing relationship, or the senior must have expressed interest in learning about annuities. Unsolicited sales calls to seniors for annuity products are a major violation. Another prohibited practice, twisting or churning annuities for seniors. This happens when an agent repeatedly recommends that a senior replace their annuity every few years just to generate new commissions. Each replacement might incur surrender charges and restart waiting periods, harming the senior while enriching the agent. California considers this elder financial abuse, which can result not only in license revocation, but also criminal prosecution. Here's a specific scenario that appears on exams. An agent meets a 70-year-old widow who has $100,000 in a bank CD. The agent recommends she move the entire $100,000 into a fixed indexed annuity with a 10-year surrender period. The widow mentions she might need some of the money for medical expenses in the next few years. Should the agent proceed? Absolutely not. This is unsuitable. The widow needs liquidity, and tying up all her liquid assets in an annuity with a long surrender period puts her at risk. The agent should recommend keeping some funds liquid and perhaps only placing a portion in the annuity, or recommend an annuity with a shorter surrender period or better withdrawal provisions. California also requires special disclosures about replacement annuities for seniors. If the annuity being replaced is less than 36 months old, the insurer must conduct additional review to determine whether the replacement is appropriate. Frequent replacements of annuities, sometimes called twisting or churning, are presumed to be unsuitable unless the agent can clearly document substantial benefits to the senior. Let me give you one more critical point about senior protections that's often tested. California requires additional training for agents who sell annuities. Before you can sell an annuity in California, you must complete an 8-hour annuity training course approved by the Department of Insurance. This training covers annuity products, suitability requirements, and the special protections for seniors. Without this training, you cannot legally sell annuities in California, even if you have a life insurance license. On your exam, if they ask what additional training is required to sell annuities, remember the 8-hour requirement. Let's recap the key points from this section. Deliver buyer's guides at or before application. Honor designated third-party notice rights. Provide enhanced 30-day free looks for seniors age 60 and older. Ensure suitability for annuity sales to seniors age 65 and older, and avoid prohibited practices like high-pressure sales and unsuitable recommendations. These consumer protection requirements demonstrate California's commitment to ensuring informed decision-making, especially for vulnerable populations. On your exam, expect questions about timing of disclosures, notice requirements, age thresholds for senior protections, and prohibited practices. Mix up those ages or timeframes, and you'll lose points. In the next section, we'll cover California claims settlement practices, including the specific timeframes and requirements that make California's claims handling rules some of the strictest in the nation. Welcome to this section on California claims settlement practices. This section covers Title 10 of the California Code of Regulations, Section 2695.5, which establishes some of the most stringent claims handling requirements in the United States. California doesn't just regulate how policies are sold, it also regulates how claims must be handled. These rules exist to protect consumers when they need their insurance most. Let's break down what you need to know. Time limits for claims handling. California imposes strict deadlines on insurers and their representatives for claims handling. Missing these deadlines can result in penalties, fines, and even bad faith lawsuits. As a licensed agent, you need to understand these timeframes because you may be the first point of contact when a claim occurs. Let's start with immediate tender. When you, as an agent, receive notice of a claim from an insured or beneficiary, you must immediately tender that claim to the insurance company. Immediately means within 1 business day. You cannot sit on a claim notice for several days while you gather information or verify details. The clock starts ticking the moment you receive notice of a loss, and your job is to get that notice to the insurer right away. Why is immediate tender so critical? Because all subsequent deadlines run from when the insurer receives notice of the claim. If you delay forwarding the claim, you're delaying the entire claims process, and that harms the beneficiary. On your exam, if they ask what an agent must do upon receiving notice of a claim, the answer is immediately tender it to the insurer. Once the insurer receives notice of a claim, they have 15 calendar days to acknowledge receipt. This acknowledgment must be in writing and must be sent to the claimant. The acknowledgment should inform the claimant what information or documentation is needed to process the claim and provide contact information for the claims representative handling the file. 15 days might seem like a long time, but remember, California is giving insurers time to assign the claim, open a file, and respond properly. Here's where it gets more specific. California also requires a 15-day response to inquiries from the insured or beneficiary. If a claimant calls or writes to the insurer asking about the status of their claim, the insurer must respond within 15 calendar days. The response must be substantive, not just, "We're working on it." The insurer must provide a meaningful update. What's been done, what information is still needed, what the expected timeline is, and whether there are any issues with the claim. This 15-day response requirement applies to every inquiry. If the beneficiary follows up multiple times, the insurer must respond to each inquiry within 15 days. Ignoring claimant communications is a serious violation of California's Fair Claims Settlement regulations. Now, let's talk about investigation commencement. Upon receiving all required documentation from the claimant, the insurer must immediately commence investigation of the claim. Immediately, in this context, means without unreasonable delay, typically within a few business days. The investigation must be thorough and objective. The insurer cannot drag their feet hoping the claimant will give up or accept a lower settlement. What does investigation involve for a life insurance claim? Verifying the insured's death, confirming the policy was in force at the time of death, identifying the proper beneficiary, reviewing the cause of death to determine if any exclusions apply, and calculating the correct death benefit. For some claims, investigation is straightforward and takes only a few days. For others, such as deaths during the contestability period or deaths involving policy exclusions, investigation may take longer, but it must begin immediately. California also imposes deadlines on claim decisions. Once the insurer has all necessary information and completes its investigation, it must accept or deny the claim within 40 calendar days. If the claim is accepted, payment must be issued within 30 calendar days of reaching agreement with the claimant. If the claim is denied, the denial must be in writing with a clear explanation of the reasons and the policy provisions supporting the denial. Here's an important point for your exam. If the insurer needs more time to investigate, perhaps because they're waiting for autopsy results or medical records, they must notify the claimant in writing, explain the reason for the delay, and provide a reasonable estimate of when a decision will be made. The insurer cannot just let the claim sit without communication. Every 30 days, if the claim remains open, the insurer must provide a status update to the claimant. Fair Claims Settlement Regulations. Now let's discuss California's Fair Claims Settlement Regulations more broadly. These regulations are found in Title 10 of the California Code of Regulations, and they establish standards for how insurers must handle claims. Violating these regulations can result in enforcement action by the California Department of Insurance, fines, and potential license suspension for agents and adjusters who participate in unfair practices. The regulations require insurers to adopt and implement reasonable standards for investigating and processing claims. These standards must be in writing and must be followed consistently. Insurers cannot make up different rules for different claims or treat similar claims differently without justification. This is the essence of good faith claims handling: consistency, fairness, and transparency. California requires specific training for insurance adjusters on California regulations. Before an adjuster can handle claims in California, they must be licensed and must complete training on California's Fair Claims Settlement regulations. This training covers the timelines we just discussed, the documentation requirements, the good faith standards, and the penalties for violations. The training ensures that adjusters understand California's consumer protections and their obligations under state law. Even if you're not an adjuster, as a life insurance agent, you should be familiar with these regulations because you may assist beneficiaries with the claims process. Understanding California's requirements helps you guide beneficiaries and ensures you don't inadvertently delay or complicate a claim. Good faith claims handling standards are at the heart of California's regulations. What does good faith mean? It means the insurer must deal fairly, honestly, and promptly with the claimant. The insurer cannot look for reasons to deny a claim that should be paid. They cannot use their superior resources and knowledge to take advantage of an unsophisticated beneficiary. They cannot delay payment, hoping the beneficiary will accept less than they're entitled to. Specific examples of bad faith claims handling include denying a claim without conducting a reasonable investigation, requesting unnecessary documentation repeatedly to delay the claim, misrepresenting policy provisions to justify a denial, offering a settlement that's unreasonably low compared to the policy's actual benefits, and failing to respond to claimant communications. Any of these practices can result in a bad faith lawsuit, where the insurer may be liable not just for the policy benefits, but also for punitive damages and the claimant's attorney fees. California also prohibits insurers from requiring claimants to jump through unnecessary hoops. For example, if a death certificate clearly shows the insured died of natural causes and the policy was unquestionably in force, the insurer cannot demand an autopsy report, extensive medical records, and interviews with family members. The insurer must be reasonable in its documentation requests. Each request must be relevant to determining coverage and calculating benefits. Another good faith requirement: the insurer must advise claimants of their rights under the policy. If a policy has multiple settlement options for the death benefit, such as lump sum, installments, or interest only, the insurer must inform the beneficiary of all available options. The insurer cannot just default to the option that's most convenient for them or that costs them the least. California's regulations also address claim denials. If an insurer denies a claim, the denial must be in writing and must include specific information. First, it must reference the policy provisions that support the denial. Second, it must explain the factual basis for the denial, what happened that triggered the exclusion or limitation. Third, it must inform the claimant of their right to dispute the denial and how to initiate that process. A vague denial letter that just says "claim denied" without explanation is a violation of California law. Let me give you a real-world example. A beneficiary submits a claim for a $500,000 life insurance policy. The insured died in a car accident 6 months after the policy was issued. The insurer investigates and discovers that the insured failed to disclose a prior DUI conviction on the application. The insurer denies the claim based on material misrepresentation. How must the insurer communicate this denial? The denial letter must state, "Your claim has been denied based on material misrepresentation in the application, as provided in Section X of the policy. Our investigation revealed that the insured failed to disclose a DUI conviction from 3 years ago in response to question Y on the application. Had this information been disclosed, the policy would not have been issued at the applied for rate. Under California law, you have the right to dispute this denial by providing additional information or requesting reconsideration. You may also file a complaint with the California Department of Insurance. That's a proper denial letter under California law. Now, let's talk about penalties for violations. California takes claims handling violations seriously. For minor violations, such as missing a deadline by a few days on a single claim, the insurer might receive a warning or a small fine. But for pattern violations, such as systematically delaying claims, denying valid claims without investigation, or failing to train adjusters properly, penalties escalate quickly. The California Insurance Commissioner can impose fines up to $10,000 per violation. If an insurer violates the same regulation repeatedly, each instance is a separate violation. So if an insurer fails to acknowledge 50 claims within 15 days, that's 50 violations and potentially $500,000 in fines. The Commissioner can also order the insurer to pay restitution to harmed claimants and can require the insurer to implement corrective action plans. For individual agents and adjusters, violations can result in license suspension or revocation. If you, as an agent, participate in unfair claims practices, such as advising a beneficiary not to file a claim, delaying the tender of a claim, or making false statements about coverage, you can lose your license. The Department of Insurance does not tolerate agents who harm consumers during the claims process. California also allows beneficiaries to sue insurers for bad faith. A bad faith lawsuit can result in damages far exceeding the policy benefits. If a jury finds that an insurer acted in bad faith, intentionally delaying or wrongfully denying a claim, they can award compensatory damages for the claimant's financial losses, emotional distress damages, and punitive damages designed to punish the insurer and deter future misconduct. Bad faith verdicts in California have reached millions of dollars in some cases. Here's an exam tip. If a question describes an insurer delaying a claim without justification, failing to communicate with a beneficiary, or denying a claim without investigation, the correct answer will involve a violation of California's Fair Claims Settlement regulations. California does not tolerate claim handling practices that put the insurer's interests ahead of the consumer's rights. One final point about claims handling: California requires insurers to maintain detailed records of all claims. These records must include dates of communications, copies of all correspondence, notes from phone calls, documentation received from claimants, investigation findings, and the basis for the claim decision. The Department of Insurance can audit these records at any time to ensure compliance with California law. If records are missing or inadequate, that's evidence of poor claims handling and can result in penalties. Let's recap the critical timeframes: immediate tender of claims by agents, 15-day acknowledgment by insurers, 15-day response to inquiries, and immediate commencement of investigation. Remember that good faith claims handling is mandatory in California, and violations result in fines, license actions, and potential bad faith lawsuits. On your exam, questions about claims handling will test whether you understand the specific timelines, the good faith standards, and the consequences of violations. California's claims regulations are designed to ensure that when a family loses a loved one and needs the life insurance death benefit, they receive prompt, fair treatment. As a licensed agent, you play a role in that process, and California expects you to uphold these consumer protections. In the next section, we'll cover California insurance marketplace regulations, including the distinctions between admitted and non-admitted insurers, and the role of the California Insurance Guarantee Association in protecting policyholders. Welcome to this section on California insurance marketplace regulations. Understanding how insurers are classified and regulated in California is essential for your exam. This section covers the distinctions between different types of insurers, the requirements for doing business in California, and the safety nets that protect policyholders if an insurer becomes insolvent. Let's break it down. Admitted versus non-admitted insurers. In California, insurers fall into two broad categories: admitted insurers and non-admitted insurers. The distinction is critical, and mixing these up on your exam will cost you points. An admitted insurer is one that holds a certificate of authority from the California Insurance Commissioner. This certificate grants the insurer permission to transact insurance business in California. To obtain this certificate, the insurer must meet stringent financial requirements, submit to California's regulatory oversight, comply with California's insurance laws and regulations, and pay premium taxes to the state. Admitted insurers are also called authorized insurers. A non-admitted insurer, also called a surplus lines insurer, does not hold a certificate of authority in California. Non-admitted insurers can only write specific types of coverage through licensed surplus lines brokers, and only when the coverage cannot be obtained from an admitted insurer. For life insurance, non-admitted insurers are extremely rare because there's ample capacity in the admitted market. However, you should understand the concept for your exam. Now let's discuss the three categories of admitted insurers: domestic, foreign, and alien. These terms are often confused, so pay close attention. A domestic insurer is one that is incorporated in California. The insurer's home state, its state of domicile, is California. Domestic insurers are subject to the most direct oversight by the California Department of Insurance, because California is their primary regulator. The department examines their financial condition, approves their rates and forms, and monitors their business practices continuously. Examples of domestic insurers include companies like State Compensation Insurance Fund and California Automobile Insurance Company. These companies were formed in California, and their headquarters are in California. For your exam, if they ask about an insurer incorporated in California, that's a domestic insurer. A foreign insurer is one that is incorporated in another U.S. state but is authorized to do business in California. The term foreign can be confusing because it doesn't mean from another country. It means from another state. For example, if an insurer is incorporated in New York but holds a certificate of authority in California, it's a foreign insurer in California. However, it's a domestic insurer in New York. Most of the major insurance companies you know, like MetLife, Prudential, and New York Life, are foreign insurers in California because they're incorporated in other states. They still must meet California's requirements to obtain a certificate of authority, including maintaining adequate reserves, submitting financial statements, and complying with California laws. The main difference is that their primary regulator is their home state, not California, though California retains significant oversight authority. An alien insurer is one that is incorporated outside the United States but is authorized to do business in California. Alien means foreign country, not foreign state. For example, if a company is incorporated in the United Kingdom, Germany, or Japan but holds a California certificate of authority, it's an alien insurer in California. Alien insurers must meet the same California requirements as domestic and foreign insurers, plus additional requirements related to international operations, currency exchange, and reinsurance. California scrutinizes alien insurers carefully to ensure they have sufficient U.S. assets to pay claims to California policyholders. Here's an exam tip. When a question asks you to identify whether an insurer is domestic, foreign, or alien, look at where it's incorporated. Incorporated in California? Domestic. Incorporated in another U.S. state? Foreign. Incorporated outside the U.S.? Alien. Don't overthink it. Now let's talk about the Certificate of Authority requirements. To obtain a Certificate of Authority in California, an insurer must submit a detailed application to the California Department of Insurance. The application includes financial statements, business plans, organizational documents, biographical information on officers and directors, and proof of adequate capital and surplus. California requires insurers to maintain minimum capital and surplus levels to ensure they can pay claims. For life insurers, the minimum capital requirement is typically $4 million, though this can vary based on the type and volume of business. The insurer must also maintain adequate reserves for all outstanding liabilities, essentially, the money set aside to pay future claims and benefits. The Department of Insurance reviews the application and may conduct on-site examinations of the insurer's operations. If the department is satisfied that the insurer is financially sound, properly managed, and will comply with California law, it issues the Certificate of Authority. This certificate must be renewed periodically, and the insurer must submit annual financial statements and reports to maintain its admitted status. If an admitted insurer violates California law, operates in an unsound manner, or becomes financially impaired, the Commissioner can suspend or revoke the certificate of authority. This prevents the insurer from writing new business in California, though existing policies remain in force and must be honored. Now let's discuss surplus lines insurance briefly. Surplus lines insurance is coverage placed with non-admitted insurers. California allows surplus lines for risks that cannot be insured in the admitted market. For life insurance, this is unusual because admitted insurers have plenty of capacity. However, for specialized risks, such as high-net-worth individuals seeking very large policies or substandard risks that admitted insurers won't cover, surplus lines might be used. Surplus lines insurance can only be placed by a licensed surplus lines broker, not a regular life insurance agent. The broker must conduct a diligent search of the admitted market and document that the coverage is unavailable from admitted insurers before placing it with a non-admitted carrier. Surplus lines policies are subject to a special surplus lines tax, typically around 3%, which is higher than the premium tax on admitted policies. Here's a critical distinction for your exam. Surplus lines insurers are not covered by the California Insurance Guarantee Association, which we'll discuss next. If a surplus lines insurer becomes insolvent, policyholders have no state guarantee fund protection. That's one reason surplus lines are a last resort for most consumers. California Insurance Guarantee Association, CAIGA. The California Insurance Guarantee Association, or TIGA, is a safety net that protects policyholders if an admitted insurer becomes insolvent. This is important consumer protection, and it's definitely tested on your exam. Let's start with the purpose of CAIGA. Insurance companies, like any business, can fail. They might mismanage their investments, underestimate their liabilities, commit fraud, or simply face catastrophic losses that exceed their reserves. When an insurer becomes insolvent and cannot pay its claims, policyholders would be left without coverage, unless there's a guarantee association. CAIGA is funded by assessments on all admitted insurers doing business in California. When an insurer fails, CAIGA steps in to pay claims and continue coverage for policyholders, up to statutory limits. Think of it as insurance for insurance. It ensures that even if your insurer fails, you're still protected. CAIGA provides coverage for life insurance, health insurance, and annuities issued by member insurers. A member insurer is any admitted insurer holding a certificate of authority in California. If you bought your life insurance policy from an admitted insurer, which is almost always the case, you have CAIGA protection. Now let's talk about the specific protections CAIGA provides. If your insurer becomes insolvent, CAIGA will continue your coverage and pay claims, subject to limits. For life insurance death benefits, CAIGA covers up to $300,000 per insured life. This means if you have a $500,000 life insurance policy and your insurer fails, CAIGA will pay up to $300,000 of the death benefit. The remaining $200,000 may be paid through the insurer's liquidation process, though that can take years and may result in only partial recovery. For cash values in life insurance policies, CAIGA covers up to $100,000 per policyholder. So if your whole life policy has $150,000 in cash value, when the insurer becomes insolvent, CAIGA will protect $100,000 of that cash value. You might lose the excess $50,000, or you might recover some of it through liquidation. For annuities, CAIGA provides up to $300,000 in present value of annuity benefits per contract owner. This protects both the accumulation value during the deferral period and the income stream during the payout period. If you have multiple annuity contracts with the same insurer, each contract is covered separately up to the limit. For health insurance, CAIGA covers up to $500,000 per insured for hospital, medical, and surgical benefits. However, This is less relevant for a life insurance exam unless you're also taking the accident and health exam. Here's a critical point for your exam. CIGA coverage applies per insured or per contract owner, not per policy. If you own multiple life insurance policies with the same insolvent insurer, CIGA's $300,000 death benefit limit applies across all your policies combined. So if you have 3 policies totaling $600,000 in death benefits, CIGA pays $300,000 total, not $300,000 per policy. Now, let's discuss what CIGA does not cover. The exclusions. First, CIGA does not cover policies issued by non-admitted or surplus lines insurers. Remember, CAIGA is funded by admitted insurers, so only policies from admitted insurers are protected. If you bought a policy from a non-admitted carrier, you're out of luck if that carrier fails. Second, CIGA does not cover certain types of policies and contracts. Policies issued to large, sophisticated organizations, such as employee benefit plans covering 50 or more employees, are not covered. The theory is that large organizations have resources to manage risk and don't need guarantee fund protection. Third, CIGA coverage is subject to the statutory limits we just discussed. Amounts exceeding those limits are not guaranteed, though you may recover something through the liquidation process. Fourth, CIGA does not cover unallocated annuity contracts. An unallocated annuity is one where benefits are not specifically allocated to individual participants, common in group retirement plans. Allocated annuities, where benefits are tied to specific individuals, are covered. Here's how the CAIGA process works in practice. When an insurer becomes financially impaired, the California Insurance Commissioner typically seeks a court order placing the insurer into conservation or liquidation. Once the order is issued, the Commissioner takes control of the insurer's operations. CIGA is notified and begins assessing the scope of coverage it must provide. CIGA will attempt to transfer policies to a solvent insurer willing to assume them. This is the preferred outcome because policyholders maintain continuous coverage without interruption, and the assuming insurer takes on the obligations within the CIGA limits. If no solvent insurer will assume the policies, CIGA directly continues coverage and pays claims. Policyholders do not need to file a claim with CIGA unless they have a specific loss or are seeking cash value withdrawals. For ongoing coverage, CIGA automatically continues the policies. However, policyholders should monitor communications from CAIGA and respond to any requests for information. One important note, CIGA coverage is not a marketing point. California law prohibits agents from advertising or promoting the existence of guarantee fund coverage when selling insurance. You cannot tell a prospect, "Don't worry if this company fails. CIGA will protect you." Why? Because it creates a false sense of security and might encourage people to buy from financially weak insurers. The guarantee fund is a safety net, not a selling point. Here's an exam scenario. An applicant asks you, "What happens if your company goes out of business? Will I lose my life insurance?" The correct answer is, all admitted insurers in California are subject to strict financial oversight by the California Department of Insurance. While insurer insolvencies are rare, California does have protections in place for policyholders. I encourage you to research the financial strength of any insurer you're considering. You should not say, "Don't worry, CIGA will cover you up to $300,000. That's a violation. Let me give you the key numbers to memorize for your exam. CIGA covers up to $300,000 per insured for life insurance death benefits, up to $100,000 per policyholder for life insurance cash values, and up to $300,000 per contract owner for annuities. These numbers appear frequently on the California exam, so lock them in. Let's recap this section. Admitted insurers hold a certificate of authority and include domestic, foreign, and alien insurers. Domestic means incorporated in California, foreign means incorporated in another U.S. state, and alien means incorporated outside the U.S. Non-admitted or surplus lines, insurers do not hold a certificate of authority and are used only for hard-to-place risks. The California Insurance Guarantee Association protects policyholders of admitted insurers in case of insolvency, with coverage limits of $300,000 for death benefits, $100,000 for cash values, and $300,000 for annuities. CAIGA does not cover non-admitted insurers or amounts exceeding statutory limits. Understanding insurer classifications and guarantee fund protections demonstrates your knowledge of California's insurance marketplace structure. These concepts are foundational to how the industry operates in California and are definitely tested on your exam. In the next section, we'll cover California-specific premium and policy requirements, including notice provisions, payment methods, and lapse procedures that are unique to California law. Welcome to this section on California-specific premium and policy requirements. This section covers California's unique rules for premium payments, agent responsibilities when handling premiums, and the specific procedures that must be followed before a policy can lapse. These requirements protect consumers from inadvertent policy lapses and ensure agents handle client funds properly. Let's dive in. Premium payment provisions. California has specific requirements for how insurers must communicate with policyholders about premium payments. These requirements are more stringent than in many other states, reflecting California's consumer-first approach to insurance regulation. Let's start with premium due date notices. Under California law, if a premium payment is due, the insurer must provide the policyholder with at least 30 days advance notice. This means the notice must be sent at least 30 days before the premium due date, not 30 days after the payment is missed. The notice must clearly state the premium amount due, the due date, the grace period that will apply if payment is not received, and the consequences of non-payment, specifically, that the policy will lapse if payment is not made within the grace period. This 30-day advance notice requirement applies to renewal premiums and to premiums due after the initial payment. For example, if your annual premium is due on June 1st, the insurer must send you a notice by May, first reminding you of the upcoming payment. The notice gives policyholders time to budget for the payment and ensures they're not caught off guard by a premium due date. Here's an important clarification. The 30-day advance notice is separate from the 60-day grace period. They serve different purposes. The advance notice is a reminder sent before the premium is due. The grace period is the time after the premium is missed, during which the policy remains in force. Don't confuse these on your exam. If a policyholder has designated a third party to receive notices, which we discussed in Section 4, the 30-day advance notice must be sent to both the policyholder and the designated third party. This dual notification ensures that someone is aware of the upcoming premium obligation, which is especially important for elderly policyholders or those who might forget to pay. Now let's talk about methods of payment acceptable under California law. California does not mandate specific payment methods, but it does require that insurers provide reasonable payment options. Most insurers accept checks, money orders, electronic funds transfer, credit cards, and debit cards. Some insurers also offer automatic bank drafts or payroll deduction for group policies. Here's what California does prohibit. Insurers cannot require payment methods that are unreasonably burdensome to the policyholder. For example, an insurer cannot require payment only by wire transfer or only in person at the insurer's home office. Payment methods must be accessible and convenient for California consumers. California also has rules about premium modes, how frequently premiums are paid. Policyholders can choose annual, semi-annual, quarterly, or monthly payment modes, depending on what the insurer offers. Insurers may charge a modest fee for more frequent payment modes to cover administrative costs, but the fees cannot be excessive or punitive. If a monthly mode costs substantially more than an annual mode on a proportional basis, that could violate California's unfair business practices laws. Now let's discuss agent fiduciary responsibilities for premium handling. This is critical for your exam and for your career. When you collect a premium from a client, you are acting as a fiduciary. That means you hold the client's money in trust and must handle it with the utmost care and honesty. California law imposes strict requirements on agents who handle premiums. First, any premium you collect from a client belongs to the insurer, not to you, until you've earned your commission. You cannot use client premiums for personal expenses, even temporarily. That's called commingling funds, and it's one of the fastest ways to lose your insurance license. Client premiums must be kept separate from your personal funds. Second, you must maintain accurate records of all premiums collected. This includes the date received, the amount, the client's name, the policy number, and the date remitted to the insurer. These records must be available for inspection by the California Department of Insurance at any time. Third, you have a duty to protect client funds from loss. If you're holding premiums, they should be in a trust account or promptly remitted to the insurer. You cannot invest client premiums in speculative ventures or expose them to risk of loss. Let's talk about prompt remittance requirements. California law requires agents to remit premiums to the insurer promptly. Promptly is defined by regulation and typically means within 15 days of receipt, though individual agency contracts may require faster remittance. Some insurers require same-day or next-day electronic transmission of premium funds. Why does prompt remittance matter? Because until the insurer receives the premium, the policy may not be in force. If you collect a premium from a client and hold it for 30 days before remitting it, and the client dies during that 30-day period, there could be a coverage dispute. Did coverage begin when you collected the premium or when the insurer received it? To avoid these problems, California requires prompt remittance. Here's a scenario that appears on exams. An agent collects a $500 premium check from a client on January 5th. The agent deposits the check into his personal checking account, planning to write a check to the insurer when he gets around to it. The agent finally sends the premium to the insurer on February 10th. Has the agent violated California law? Absolutely. First, the agent commingled funds by depositing the premium into his personal account. Second, the agent failed to remit promptly. 35 days is not prompt remittance. This agent could face license suspension, fines, and a requirement to reimburse the client for any losses. California also requires agents to provide receipts for premiums collected. The receipt should show the date, amount, policy number or application number, and the agent's name and license number. This protects both the client and the agent by creating a paper trail of the transaction. If an agent misappropriates client premiums, meaning they steal the money or use it for personal purposes, that's not just a licensing violation, it's a crime. California Insurance Code Section 1738 makes it a felony to embezzle, misappropriate, or convert to personal use any funds received as an insurance agent. Convicted agents can face imprisonment, restitution orders, and permanent license revocation. The Department of Insurance takes premium theft extremely seriously. One more point about premium handling. If you're an independent agent representing multiple insurers, you must keep separate records for each insurer. Premiums collected for Company A cannot be used to cover premiums owed to Company B, even temporarily. Each insurer's funds must be accounted for separately and remitted promptly. Policy lapse and termination. Now, let's discuss the process and requirements for policy lapse and termination in California. This ties back to the grace period we covered in Section 2, but now we'll look at the full picture of what happens when a premium is not paid. First, remember that California requires a 60-day grace period for life insurance policies. This is longer than most states, and it's a key California distinction. The grace period begins on the premium due date, not when the insurer sends a notice or when the policyholder realizes payment is overdue. If your premium is due on March 1st, the grace period runs from March 1st through April 29th, 60 days. The policy cannot lapse until the grace period expires. During the 60-day grace period, the policy remains in full force. If the insured dies during this period, the death benefit is paid, minus the unpaid premium. Coverage does not lapse just because a premium payment is missed. This protects policyholders from losing coverage due to temporary financial difficulties, forgetfulness, or mail delays. California also requires specific notices before a policy can lapse. Within 30 days of a missed premium, the insurer must send written notice to both the policyholder and any designated third party. This is the notice requirement we discussed earlier. The notice must clearly state that a premium payment was missed, the amount due, the grace period expiration date, and the consequences of non-payment. Let's clarify the timeline because this is often tested. Premium due date, Day 1. Insurer has 30 days to send a notice of missed premium, Day 1 through Day 30. Grace period runs for 60 days, Day 1 through Day 60. Policy lapses if premium is not paid by Day 61. So the policyholder has 60 days to pay, and the insurer must notify them within 30 days that payment is overdue. The required notice must include specific information. It must state the policy number, the premium amount due, the original due date, the grace period expiration date, and a clear warning. If payment is not received by grace period expiration date, your policy will lapse and coverage will terminate. The notice must also inform the policyholder of their right to reinstate the policy within 2 years if it does lapse. If the policyholder has designated a third party for notices, that third party must receive the same notice simultaneously. The insurer cannot send notice to the policyholder and then wait a week to notify the third party. Both must be notified together. This ensures that if the policyholder misses the notice or doesn't act on it, the designated third party has time to step in and prevent the lapse. Now let's talk about the policyholder's rights during the grace period. During these 60 days, the policyholder can pay the premium at any time without penalty or additional interest, and the policy continues without interruption. There's no late fee, no interest charge, and no underwriting required. Just pay the premium and you're current. If the policy has cash value, the insurer may offer an automatic premium loan provision. This means if the premium is not paid by the end of the grace period, the insurer automatically loans the premium amount from the policy's cash value to keep the policy in force. The loan is subject to interest, and it reduces the death benefit and cash value by the amount borrowed plus interest. However, the policy does not lapse. The automatic premium loan provision must be included in the policy contract and agreed to by the policyholder at issue. Here's an important right during the grace period. The policyholder can surrender the policy for its cash value or exercise any non-forfeiture options at any time. They're not locked into waiting until the grace period expires. If a policyholder decides they no longer want the coverage, they can surrender it during the grace period and receive the full cash value, minus any outstanding loans or unpaid premiums. Now, what are the consequences of lapse under California law? If the premium is not paid by the end of the 60-day grace period and no automatic premium loan is in effect, the policy lapses. Lapse means the policy terminates and coverage ends. The insurer is no longer obligated to pay a death benefit if the insured dies after the lapse date. However, California provides some protections even after lapse. First, as we discussed in Section 2, the policyholder has 2 years from the date of lapse to reinstate the policy by providing evidence of insurability and paying all back premiums plus interest. Reinstatement puts the policy back in force, though a new contestability period may begin for statements made in the reinstatement application. Second, if the policy has cash value, the policyholder is entitled to receive that cash value or apply it to a non-forfeiture option. Non-forfeiture options include reduced paid-up insurance, which provides a lower death benefit with no further premiums required, or extended term insurance, which provides the original death benefit for a limited period with no further premiums. The policyholder must elect a non-forfeiture option within a specified time frame, typically 60 days after lapse. California law requires that policies clearly explain non-forfeiture options and provide tables showing how much reduced paid-up or extended term coverage is available based on the policy's cash value. These tables must be included in the policy contract and must be easy for consumers to understand. Here's an exam scenario. A policyholder with a $100,000 whole life policy stops paying premiums. The policy has $10,000 in cash value. The grace period expires and the policy lapses. What are the policyholder's options? First, surrender the policy for $10,000 cash. Second, apply the $10,000 cash value to purchase reduced paid-up insurance, maybe $25,000 of coverage with no further premiums due. Third, apply the $10,000 to purchase extended term insurance, $100,000 of coverage for perhaps 5 years with no further premiums. Fourth, do nothing for now, but reinstate within 2 years by proving insurability and paying back premiums. Those are the 4 non-forfeiture options under California law. One more consequence of lapse. Any riders or additional benefits attached to the policy also lapse. If the policy had a waiver of premium rider, an accidental death benefit rider, or a guaranteed insurability rider, those terminate along with the base policy. The policyholder cannot keep the riders in force if the base policy has lapsed. California also requires insurers to make reasonable efforts to prevent lapses. This means proactive communication, clear notices, and flexibility in payment arrangements. Some insurers offer grace period extensions for policyholders experiencing financial hardship, or they may allow partial premium payments to keep the policy in force while the policyholder catches up. While not required by law, these practices align with California's consumer protection philosophy. Finally, let's discuss the prohibition against backdating premium payments. If a policy lapses and the insured dies during the lapse period, the insurer cannot accept a late premium payment and backdate coverage to before the death. That would be fraud. Once a policy lapses, coverage is terminated, and a death during the lapse period is not covered, unless the policy is properly reinstated before the death with full underwriting and approval. Let's recap the key points of this section. Insurers must provide 30 days advance notice of premium due dates. Agents must handle premiums as fiduciaries and remit them promptly within 15 days. California requires a 60-day grace period before lapse. Insurers must notify policyholders and designated third parties within 30 days of a missed premium, and policyholders have rights during the grace period and options after lapse through non-forfeiture provisions. These premium and lapse requirements reflect California's commitment to preventing inadvertent coverage losses and ensuring consumers are fully informed about their policy status. On your exam, expect questions about the 30-day notice requirement, the 60-day grace period, agent fiduciary duties, and non-forfeiture options. Mix up those numbers or overlook the notice requirements, and you'll lose points. In the next section, we'll cover California variable life insurance regulations, including the unique grace period for variable products and the specific approval requirements that apply to variable life insurance in California. Welcome to this section on California variable life insurance regulations. Variable life insurance is unique because it combines life insurance protection with investment features, and California has specific regulations governing these products under Title 10 of the California Code of Regulations, Section 2534.3. These rules ensure consumer protection while allowing for the investment flexibility that makes variable life attractive. Let's explore what makes California's approach distinct. Grace period for variable life. First, let's address a critical distinction you must know for your exam. Variable life insurance products have a different grace period than traditional life insurance in California. While traditional life insurance requires a 60-day grace period, variable life insurance requires a 31-day minimum grace period. That's right, 31 days, not 60. This is one of the most commonly missed exam questions, so lock this in. Traditional life gets 60 days, variable life gets 31 days minimum. Why the difference? Variable life insurance policies have separate accounts with fluctuating values based on investment performance. The shorter grace period reflects the investment nature of these products and aligns with federal securities regulations that also govern variable life insurance. However, 31 days is still longer than many states require, demonstrating California's consumer protection standards even for investment-linked products. The 31-day grace period begins on the premium due date, just like with traditional life insurance. If your variable life premium is due on January 15th, the grace period runs from January 15th through February 14th. That's 31 days. During this entire period, the policy remains in force, meaning the death benefit is still payable if the insured dies, minus any unpaid premium. Now let's talk about policy value adjustments during the grace period. This is where variable life gets complicated, and it's definitely tested on your exam. During the grace period, the separate account values continue to fluctuate based on market performance. If the stock market goes up, your account value increases. If it goes down, your account value decreases. The investment risk doesn't pause just because you missed a premium payment. Here's the key point. If the insured dies during the 31-day grace period and the premium has not been paid, the insurer pays the death benefit minus the unpaid premium and any policy loans outstanding. However, the separate account values are calculated as of the date of death, not as of the last paid premium date. This means the beneficiary benefits from any market gains during the grace period, but also bears any market losses. Let me give you an example. Say you have a variable universal life policy with a $250,000 death benefit and a separate account value of $50,000. Your premium of $500 is due on March 1st, but you don't pay it. On March 15th, still within the 31-day grace period, the insured dies. By that date, the market has performed well, and the separate account value has increased to $52,000. The death benefit paid would be $250,000, but the insurer would deduct the $500 unpaid premium, so the beneficiary receives $249,500, and the separate account value of $52,000 is part of the policy's overall cash value calculation. The market gains during the grace period are not forfeited. Conversely, if the market had declined and the separate account value dropped to $48,000 by the date of death, that lower value would apply. The policyholder, or in this case, the beneficiary, bears the investment risk right up until the death claim is paid. Premium payment provisions for variable life are similar to traditional life insurance, but with some important differences. Variable life policies often have flexible premium provisions, especially variable universal life. This means the policyholder can adjust premium amounts or skip premiums as long as the policy's cash value is sufficient to cover the monthly deductions for cost of insurance and other charges. However, California requires that variable life policies clearly disclose the minimum premium necessary to keep the policy in force and the consequences of underfunding the policy. If premiums are insufficient, the separate account values may be depleted over time, causing the policy to lapse even without a formal missed premium payment. Insurers must provide annual statements showing whether the current premium level is adequate to maintain coverage. California also mandates that variable life policies include illustrations showing how the policy performs under different investment return scenarios. These illustrations must include a hypothetical 0% return, a hypothetical gross return equal to the maximum rate allowed by law, currently 12%, and at least one intermediate return rate. The illustrations must clearly state that actual returns will vary and that past performance does not guarantee future results. This helps consumers understand the range of possible outcomes. California-specific variable life requirements. Now, let's discuss the specific requirements that apply uniquely to variable life insurance in California. These go beyond federal securities regulations and reflect California's additional consumer protections. First, Commissioner approval requirements for investment policy changes. Variable life insurance policies offer various investment options, separate accounts invested in stocks, bonds, money market funds, and other securities. The insurance company establishes an investment policy for each separate account. defining the account's objectives, permissible investments, and risk parameters. Under California law, if the insurer wants to change the investment policy of a separate account, for example, shifting from a conservative bond fund to an aggressive growth stock fund, the insurer must obtain prior approval from the California Insurance Commissioner. The insurer cannot simply change the investment strategy without regulatory review. Why does California require this? Because policyholders chose their separate accounts based on specific investment objectives and risk profiles. Unilateral changes to the investment policy could expose policyholders to risks they didn't agree to. The Commissioner reviews proposed changes to ensure they're reasonable, clearly disclosed to policyholders, and not detrimental to consumer interests. The approval process requires the insurer to submit a detailed explanation of the proposed change, the reasons for the change, how policyholders will be notified, and whether policyholders will have the option to transfer to different separate accounts without charge. The Commissioner may approve, deny, or approve with conditions. This is a significant protection not found in many other states. Here's an exam scenario. An insurer offers a variable life policy with a balanced growth, separate account invested 60% in stocks and 40% in bonds. The insurer decides to change the allocation to 80% stocks and 20% bonds to pursue higher returns. Can the insurer make this change immediately? No. The insurer must first seek approval from the California Insurance Commissioner, provide notice to policyholders, and allow policyholders to transfer to other accounts if they disagree with the new allocation. Failing to obtain approval is a violation of California regulations. Now let's discuss deferral provisions for payments. California regulations allow insurers to defer certain payments from variable life policies under specific circumstances. For example, if a policyholder requests a loan or partial withdrawal from the separate account, and the insurer reasonably believes that the securities in the account cannot be liquidated without significant loss due to market conditions, the insurer may defer the payment for up to 6 months. However, deferrals are not automatic. The insurer must demonstrate to the Commissioner that immediate liquidation would harm policyholders due to market disruption, lack of liquidity, or other extraordinary circumstances. Routine market volatility does not justify deferrals. The insurer must also notify affected policyholders of the deferral and the reasons for it. Deferrals protect both the insurer and the policyholders remaining in the separate account. If large withdrawals force the insurer to sell securities at depressed prices, it harms everyone's account values. Temporary deferrals during market crises allow the situation to stabilize. However, California limits deferrals to protect policyholders' access to their funds. Death benefit payments, however, cannot be deferred under any circumstances. If the insured dies, the death benefit must be paid promptly, according to the claims settlement timeframes we discussed in Section 5. Investment market conditions are not an excuse to delay death benefit payments. Next, let's cover minimum death benefit guarantees. Variable life insurance combines a death benefit with investment risk, but California requires that policies guarantee a minimum death benefit regardless of separate account performance. This minimum guarantee protects policyholders from the risk that poor investment performance could cause the death benefit to disappear entirely. For traditional variable life insurance, not variable universal life, California requires that the policy guarantee a fixed death benefit as long as premiums are paid as scheduled. Even if the separate account performs poorly and the cash value declines, the death benefit remains at the face amount stated in the policy. The policyholder bears investment risk on the cash value, but not on the death benefit. For variable universal life insurance, the rules are more complex because these policies have flexible premiums and death benefits. However, California still requires a minimum guaranteed death benefit, typically equal to the policy's net amount at risk. This ensures that even if the separate account value drops to zero, there's still a death benefit payable as long as the policy hasn't lapsed. California regulations also require clear disclosure of how the death benefit is calculated and what happens to the separate account value at death. For variable life, the death benefit is typically the face amount, plus any separate account value in excess of the guaranteed amount. For variable universal life, the death benefit may be calculated differently depending on which death benefit option the policyholder chose. All of this must be clearly explained in the policy contract. Here's an important exam point. California requires insurers to illustrate how the death benefit fluctuates based on separate account performance. Policyholders must understand that while there's a minimum guarantee, the actual death benefit can be higher if investments perform well. The illustrations must show multiple scenarios so consumers can make informed decisions. Finally, let's discuss cash value determination frequency. California mandates that separate account values be calculated at least monthly. This means at least once every 30 days, the insurer must determine the net asset value of each separate account, calculate each policyholder's proportionate share, and update the policy's cash value. Most insurers calculate separate account values daily, not just monthly, because that's standard practice in the securities industry. Daily valuations allow policyholders to track their account performance in real time and make timely decisions about transfers between accounts. However, California's minimum requirement is monthly, ensuring that even if daily valuation isn't provided, policyholders receive at least monthly updates. Why does frequency matter? Because variable life insurance is an investment product, and investors need current information to make informed decisions. If account values were only calculated quarterly or annually, policyholders wouldn't know whether their investments were performing well or poorly until long after the fact. Monthly minimum valuation ensures reasonable transparency. California also requires that policyholders receive at least annual statements showing their separate account values, premiums paid, deductions taken, death benefit, and cash surrender value. Many insurers provide quarterly statements, and some offer online access for real-time viewing. But the regulatory minimum is annual. The annual statement must be clear, comprehensive, and easy to understand. It must show the beginning balance, all transactions during the year, investment gains or losses, and the ending balance. It must also show whether the current premium level is sufficient to keep the policy in force based on current assumptions. If the policy is underfunded and at risk of lapsing, that must be clearly disclosed. One more California-specific requirement. Variable life insurance can only be sold by agents who hold both a California life insurance license and FINRA securities registrations, typically Series 6 or Series 7, plus Series 63. This is because variable life is both an insurance product and a securities product. Federal law requires securities licensing, and California enforces this strictly. If you try to sell variable life without the proper securities licenses, you're violating both California insurance law and federal securities law. Additionally, effective January 1, 2025, California requires all agents selling variable life or variable universal life to complete a 2-hour variable life continuing education course with every license renewal. This ongoing training requirement ensures agents stay current on variable product features, risks, and regulatory requirements. It's part of your 24-hour CE requirement, specifically carved out for variable life sales. That completes this section on California variable life insurance regulations. Let's recap the critical points. Variable life has a 31-day grace period, not 60 days like traditional life insurance. Separate account values continue to fluctuate during the grace period. The California Insurance Commissioner must approve any changes to separate account investment policies. California requires minimum death benefit guarantees to protect policyholders from total investment losses. Separate account values must be determined at least monthly, and policyholders must receive at least annual statements. And remember, selling variable life requires both insurance and securities licensing, plus ongoing 2-hour CE starting in 2025. Variable life insurance is complex because it merges insurance and investments, and California's regulations reflect that complexity. On your exam, Expect questions about the 31-day grace period, the commissioner approval requirement for investment policy changes, minimum death benefit guarantees, and licensing requirements for variable products. These are favorite exam topics because they're unique to California or represent significant consumer protections. In the next section, we'll cover the California Unclaimed Life Insurance and Annuities Act, which requires insurers to search for beneficiaries and report unclaimed benefits, another area where California leads the nation in consumer protection. Welcome to this section on California Unclaimed Life Insurance and Annuities Act. This section covers California Insurance Code, Sections 10,509.940 through 10,509.946, which were enacted to address a serious problem: life insurance and annuity benefits going unpaid because insurers failed to determine whether insureds had died. California was a pioneer in this area, creating obligations that have since been adopted by many other states. Let's explore what makes California's approach unique and comprehensive. Insurer obligations. The foundation of California's Unclaimed Life Insurance and Annuities Act is a simple but powerful concept. Insurers must take proactive steps to determine if their insureds have died and locate beneficiaries entitled to benefits. For decades, insurers operated on a claims-made basis. They only paid death benefits when beneficiaries filed claims. If a beneficiary didn't know about the policy or didn't file a claim, the insurer simply held on to the money indefinitely. California said this was unacceptable. Let's start with the Death Master File search requirements. The Death Master File, or DMF, is a database maintained by the Social Security Administration that contains records of deceased individuals. It includes names, Social Security numbers, birth dates, death dates, and last known addresses. California requires life insurers and annuity issuers to periodically compare their in-force policies and retained asset accounts against the Death Master File to identify potential matches indicating that an insured or annuitant has died. Here's how it works. At least semi-annually, meaning at least twice per year, insurers must run their policy databases against the Death Master File. If there's a match on Social Security number, or a combination of first name, last name, and date of birth, the insurer must investigate whether the matched individual is indeed the insured on the policy. This triggers the insurer's obligation to locate beneficiaries and initiate the claims process. Why is this important? Because many beneficiaries don't know a policy exists. Maybe the insured never told their beneficiaries about the coverage. Maybe the policy documents were lost. Maybe the insured died suddenly without the chance to share this information. Without the Death Master File matching requirement, these death benefits could remain unclaimed for decades, while insurers continued collecting premiums or earning investment income on the death proceeds. Now, let's discuss the timeframes for locating beneficiaries. Once an insurer identifies a potential death match through the Death Master File, they must take several time-sensitive steps. First, within 90 days of the death match, the insurer must complete a good faith effort to confirm the death and locate beneficiaries. This includes requesting a certified death certificate, searching internal records for beneficiary contact information, and using other reasonable means to find beneficiaries. If the insurer confirms the insured has died and the policy was in force at the time of death, they must attempt to locate the beneficiaries. California requires insurers to use reasonable efforts, which may include searching public records, using locator services, checking with state unclaimed property offices, and contacting last known addresses. The insurer cannot simply send one letter to an old address and call it quits. Reasonable efforts means genuine, sustained attempts to find the people entitled to the benefits. If the insurer successfully locates beneficiaries, they must notify them of the death benefit and provide claim forms within 30 days. The notice must be clear and must not create unnecessary barriers to claiming benefits. It should include the policy number, death benefit amount, claim form, and instructions for submitting the claim. The insurer should also offer assistance if beneficiaries have questions or need help completing the forms. Here's a critical timeline to remember for your exam. Within 90 days of a death match, the insurer must confirm the death and attempt to locate beneficiaries. Within 30 days of locating beneficiaries, the insurer must notify them and provide claim forms. Once a complete claim is submitted, the insurer has 30 days to pay the death benefit. These timeframes are strict, and violations can result in penalties. Now let's talk about reporting to the California Controller. If the insurer cannot locate beneficiaries despite reasonable efforts, or if beneficiaries do not respond to notices, the death benefit eventually becomes unclaimed property under California law. Unclaimed property must be reported and remitted to the California State Controller's Office, which maintains the state's unclaimed property program. The reporting timeline is important. Life insurance death benefits are considered unclaimed if the insurer has not been able to locate beneficiaries, or if beneficiaries have not claimed the benefits within 3 years of the insured's death. At that point, the insurer must report the unclaimed benefit to the controller and turn over the funds. The report to the controller must include detailed information: the insured's name and last known address, the beneficiary's name and last known address if known, the policy number, the death benefit amount, the date of death, and a description of the insurer's efforts to locate beneficiaries. This information is uploaded to California's Unclaimed Property Database, which is searchable by the public. This allows beneficiaries to find unclaimed benefits even years after the insured's death. Once the funds are turned over to the controller, the state becomes the custodian. Beneficiaries can claim the funds from the state at any time. There's no statute of limitations. The state holds the money in perpetuity until the rightful owner comes forward. This is far better than having the money sit indefinitely in the insurer's general account, where beneficiaries might never find it. Now, let's discuss penalties for non-compliance. California takes these requirements seriously because they involve billions of dollars in benefits owed to consumers. Insurers that fail to comply with the Death Master File search requirements, fail to locate beneficiaries, or fail to report unclaimed benefits to the controller face significant penalties. First, the California Insurance Commissioner can impose administrative fines. These fines can be up to $10,000 per violation, and each policy where the insurer failed to perform required searches or notifications can constitute a separate violation. If an insurer failed to search the Death Master File for 10,000 policies, that's potentially 10,000 violations and $100 million in fines. The Commissioner has used these penalties aggressively to enforce compliance. Second, insurers must pay interest on late benefit payments. If an insurer should have paid a death benefit but failed to do so because they didn't conduct proper Death Master File searches or locate beneficiaries, they owe interest on the death benefit from the date it should have been paid. California's interest rate for unpaid benefits is typically between 7% and 10% per year, which accumulates quickly. An insurer that held a $100,000 death benefit for 5 years could owe $35,000 to $50,000 in interest penalties. Third, insurers face reputational damage and potential lawsuits. Several major life insurers have been sued in class action lawsuits for failing to pay death benefits they knew or should have known were due. These lawsuits resulted in settlements worth hundreds of millions of dollars and forced insurers to reform their practices. California's regulations provide a clear standard that can be used to establish liability in such cases. Fourth, willful violations can result in criminal penalties. If an insurer knowingly fails to comply with the unclaimed property reporting requirements with intent to defraud the state or beneficiaries, that's a crime. While criminal prosecution is rare, the possibility exists for egregious violations. Here's an exam scenario. An insurer conducts Death Master File searches annually instead of semi-annually as required. Over 2 years, the insurer identifies 50 death matches but delays notifying beneficiaries for 6 months beyond the 90-day requirement. The insurer eventually pays all the death benefits but without interest for the delay period. Has the insurer violated California law? Yes, in multiple ways. First, annual searches instead of semi-annual violate the frequency requirement. Second, delays beyond 90 days to notify beneficiaries violate the timeline requirement. Third, failure to pay interest on delayed benefits violates the penalty provision. This insurer would face fines and be required to pay retroactive interest. Consumer protections. Now, let's turn to the consumer protections established by California's Unclaimed Life Insurance and Annuities Act. These protections ensure that beneficiaries receive what they're entitled to, even if they don't know about the policy or can't immediately locate the insurer. First, let's discuss the rights of beneficiaries under California law. Beneficiaries have the right to receive death benefits when the insured dies, regardless of whether they actively file a claim. This is a fundamental shift from the old claims-made model. If an insurer knows, or should have known, through death master file searches that the insured died, the insurer has an obligation to find the beneficiary and pay the benefit, not wait passively for the beneficiary to discover the policy and file a claim. Beneficiaries also have the right to full disclosure. When an insurer contacts a beneficiary about an unpaid death benefit, the insurer must disclose the full amount of the benefit, including any interest that has accrued, any dividends or investment gains that should be credited, and any fees or charges that will be deducted. The insurer cannot lowball the initial offer, hoping the beneficiary will accept less than they're entitled to. Beneficiaries have the right to interest on delayed payments. If the insurer failed to pay a death benefit when it should have, either because the insurer didn't conduct required death master file searches, didn't locate the beneficiary despite reasonable efforts being possible, or simply delayed processing the claim, the beneficiary is entitled to interest from the date the benefit should have been paid. California's interest rate for these situations is set by statute and compounds annually. Let me give you an example of how significant this interest can be. Say an insured died in 2015. The policy had a $200,000 death benefit. The insurer failed to conduct death master file searches, and the beneficiary didn't discover the policy until 2023, 8 years later. At an 8% annual interest rate, the interest would be approximately $85,000, meaning the total payment to the beneficiary would be $285,000, not just $200,000. This interest penalty incentivizes insurers to comply with search and notification requirements. Beneficiaries also have the right to claim benefits from California's Unclaimed Property Database. If the insurer turned the death benefit over to the California State Controller as unclaimed property, the beneficiary can search the controller's database, file a claim, and receive the funds. The process is straightforward. Search the database at claimmoney.ca.gov, verify your identity, and submit a claim form. The controller typically processes claims within 90 to 180 days and pays the full amount with no fees or deductions. Here's an important consumer protection. There's no statute of limitations on unclaimed property in California. If your great-grandmother had a life insurance policy in 1950 and it was never claimed, you can still claim it today if you're the rightful beneficiary. The money doesn't revert to the state or the insurer. It's held in trust for beneficiaries indefinitely. This is one of the strongest consumer protections in unclaimed property law. Now let's discuss the claims process for unclaimed benefits. If a beneficiary discovers they're entitled to a life insurance death benefit that was never paid, what should they do? First, contact the insurance company directly. Provide the policy number if known, or provide the insured's name, social security number, and date of death. The insurer must search their records and respond within a reasonable time frame, typically 30 days, indicating whether a policy exists and whether a death benefit is payable. If the insurer confirms a benefit is owed, they must provide a claim form and process the claim within 30 days of receiving complete documentation. The death benefit must include interest from the date of death if the insurer failed to comply with death master file search requirements. If the insurer denies the claim, They must provide a written explanation with specific reasons and policy provisions supporting the denial. If the beneficiary cannot locate the insurer, perhaps the company was acquired, changed names, or went out of business, the beneficiary should check with the California Department of Insurance. The department maintains records of all insurers that have operated in California and can help track down successor companies or direct beneficiaries to the Guarantee Association if the insurer became insolvent. The beneficiary should also search California's Unclaimed property database. Even if the beneficiary hasn't been contacted by the insurer or the controller, their unclaimed benefit may be in the database waiting to be claimed. Searches are free, and the website provides instructions for filing claims. Here's a consumer protection tip that's good for your clients. Advise them to keep a list of their life insurance policies in a safe place and share it with their beneficiaries. Include the insurer name, policy number, agent contact information, and approximate death benefit. This simple step can prevent benefits from going unclaimed. Many people also keep copies of policy documents in a safe deposit box or with their estate planning attorney. California also protects beneficiaries from unreasonable documentation requirements. While insurers can require a certified death certificate and proof of the beneficiary's identity, they cannot demand excessive documentation that creates barriers to claiming benefits. For example, requiring beneficiaries to provide the original policy document when the insurer has its own records of the policy is unreasonable. California's regulations require that insurers' claims processes be fair and not designed to discourage claims. Interest requirements on delayed payments are a key enforcement mechanism. Let's be clear about when interest is owed. First, if the insurer failed to conduct required death master file searches and therefore didn't know the insured had died, interest runs from the date of death. Second, if the insurer conducted searches, identified a death match, but failed to locate beneficiaries despite reasonable efforts being possible, interest runs from 90 days after the death match. Third, if the insurer located beneficiaries but delayed processing the claim, interest runs from when the claim should have been paid under normal claims settlement timeframes. The interest rate is set by California statute and is typically tied to the legal rate of interest for judgments, currently 10% per year, though it can vary. This rate is intentionally high to create a strong incentive for insurers to comply with their obligations. Compare this to the 3% to 5% rates insurers might earn on invested death benefit funds, and you can see why paying 10% interest is a significant penalty. Interest compounds annually, meaning each year's interest is added to the principal, and the next year's interest is calculated on the new total. Over time, this compounding can result in interest amounts that rival or exceed the original death benefit, as we saw in the earlier example. One more consumer protection worth noting. California prohibits insurers from using retained asset accounts as a way to avoid death master file obligations. A retained asset account is when the insurer, instead of paying the death benefit as a lump sum, places it in an account that earns interest and provides the beneficiary with a checkbook to draw on the funds. Some insurers used these accounts to delay turning over benefits, claiming they were still in-force accounts subject to different rules. California clarified that retained asset accounts are subject to the same death master file search and beneficiary location requirements as policies. If an insurer knows the insured died and establishes a retained asset account, they must still conduct searches, locate beneficiaries, and notify them. They cannot use retained asset accounts to circumvent their obligations under the Unclaimed Life Insurance and Annuities Act. Let's recap this section's essential points. Insurers must conduct death master file searches at least semi-annually to identify deceased insureds. Within 90 days of a death match, insurers must confirm the death and attempt to locate beneficiaries. If beneficiaries cannot be located, benefits must be reported to the California Controller as unclaimed property within 3 years of death. Penalties for non-compliance include administrative fines, interest on delayed payments, and potential criminal prosecution for willful violations. Beneficiaries have strong rights under California law. The right to receive benefits even without filing a claim, the right to full disclosure of amounts owed, the right to interest on delayed payments at 10% annually, and the right to claim benefits from the state's Unclaimed Property Program with no statute of limitations. This act represents California's leadership in consumer protection. It addresses a fundamental injustice: insurers holding on to death benefits that rightfully belong to beneficiaries simply because beneficiaries didn't know about the policies. On your exam, expect questions about the Deathmaster file search frequency, the 90-day timeline for locating beneficiaries, reporting requirements to the controller, and beneficiaries' rights to interest on delayed payments. In the next section, we'll cover California special training requirements effective in 2025, including the new 4-hour cash value life insurance training requirement and the 2-hour variable life CE requirement. These are brand new requirements that will definitely appear on your exam. Welcome to this section on California special training requirements. This section covers brand new training mandates that California implemented to ensure producers have specialized knowledge before selling complex life insurance products. These requirements reflect California's recognition that cash value life insurance and variable life products require deeper understanding than basic term insurance. Since these are new requirements, they're extremely likely to appear on your exam. Let's break down exactly what you need to know. Cash value life insurance training. California has created a training requirement specifically for cash value life insurance products. This training is separate from your pre-licensing education and focuses exclusively on the features, benefits, risks, and suitability considerations of cash value policies. Let's start with who this applies to. The 4-hour cash value life insurance training requirement applies to newly licensed producers who were licensed on or after January 1st, 2024. Pay attention to that date, January 1st, 2024. If you were licensed before that date, you're grandfathered and don't need this training. But if you received your California life insurance license on or after January 1st, 2024, you must complete this 4-hour training before you can solicit cash value life insurance products. What exactly is cash value life insurance? It's any permanent life insurance policy that builds cash value over time. This includes whole life, universal life, indexed universal life, and variable universal life. It does not include term life insurance because term policies don't accumulate cash value. So if you're a newly licensed producer and you only want to sell term insurance, you don't need this training. But if you want to sell whole life or any form of universal life, this 4-hour course is mandatory. The timing requirement is critical. You must complete this training before soliciting cash value life insurance. Soliciting means any activity intended to lead to a sale. Making presentations, providing illustrations, discussing policy features with prospects, or recommending specific products. You cannot legally engage in these activities until you've completed the 4-hour training, even if you have your life insurance license. Here's an exam scenario. A producer receives her California life insurance license on March 1st, 2024. She immediately begins meeting with clients to discuss term life insurance. In June 2024, a client asks about whole life insurance. Can the producer discuss whole life at that meeting? No. Not unless she has already completed the required 4-hour cash value life insurance training. If she hasn't completed the training, she must either refer the client to a trained producer or complete the training before the next meeting. Selling cash value life insurance without this training is a license violation. The training must be completed through a California Department of Insurance-approved education provider. You cannot just read articles online or watch YouTube videos and claim you've satisfied the requirement. The course must be approved, and you must receive a certificate of completion that you can provide to the department if requested. Most approved providers offer the course online, making it convenient to complete on your own schedule. What does the 4-hour training cover? The curriculum includes the mechanics of how cash value accumulates, the differences between whole life and universal life products, how policy illustrations work and what assumptions they're based on, the tax treatment of cash value growth and loans, surrender charges, and how they work, policy loan provisions and interest rates, non-forfeiture options, and suitability considerations, when cash value life insurance is appropriate for a client and when it's not. The training also covers common sales practice violations specific to cash value products. These include misrepresenting cash value accumulation rates, failing to disclose surrender charges, promoting cash value policies as investment vehicles without explaining insurance costs, and encouraging policy loans without explaining the impact on death benefits. California wants to ensure that newly licensed producers understand not just how these products work, but also how to sell them ethically and in compliance with regulations. Now, this requirement applies to both resident and non-resident licensees. If you're licensed in another state but want to sell cash value life insurance to California residents under your non-resident California license, and you were licensed on or after January 1st, 2024, you must complete California's 4-hour cash value training. Your home state's training doesn't substitute for California's requirement. California sets its own standards, and non-residents must comply. Here's an important point. This is a one-time training requirement, not a continuing education requirement. Once you complete the 4-hour course, you don't need to repeat it with each license renewal. It's a prerequisite for selling cash value products, not an ongoing CE obligation. However, it does not count toward your 24-hour CE requirement for license renewal. It's separate and additional. Let me clarify the grandfather provision because this confuses many people. The requirement only applies to producers licensed on or after January 1st, 2024. So, if you were licensed on December 31st, 2023, or any earlier date, you're exempt. You can continue selling cash value life insurance without this training. But if you were licensed on January 1st, 2024, or later, the training is mandatory. The cutoff date is clear and inflexible. Why did California implement this requirement? Because cash value life insurance is complex, and California has seen numerous consumer complaints and regulatory violations involving these products. Producers who don't fully understand cash value policies may unintentionally mislead clients, misrepresent policy features, or recommend unsuitable products. The 4-hour training ensures a baseline level of knowledge before producers enter this market. On your exam, expect questions like, a producer licensed on June 15, 2024, wants to sell indexed universal life insurance. What must the producer do first? The correct answer is complete the required 4-hour cash value life insurance training. Or, does the 4-hour cash value training requirement apply to term insurance? The answer is no. It applies only to cash value products. Variable life insurance training. Now let's discuss the variable life insurance training requirement, which is also effective January 1st, 2025, but works differently from the cash value training. This is a 2-hour continuing education requirement that applies to all producers who sell variable life or variable universal life insurance. First, let's clarify what variable life insurance is. Variable life and variable universal life are life insurance products with investment features. The cash value is invested in separate accounts, essentially mutual funds, and the policyholder bears the investment risk. These products are regulated both as insurance products under California insurance law and as securities under federal securities law. Because they combine insurance and investments, they require specialized knowledge. The 2-hour variable life CE requirement is an ongoing requirement for every license renewal. Unlike the cash value training, which is one time, this variable life training must be completed every 2 years as part of your 24-hour continuing education requirement. So if you sell variable life products, you need to budget 2 of your 24 CE hours specifically for variable life training. This requirement applies to all producers selling variable life or variable universal life, regardless of when they were licensed. It doesn't matter if you've been licensed for 20 years or 20 days. If you're selling variable products as of January 1st, 2025, you must complete the 2-hour CE course during your next renewal period and every renewal period thereafter. Here's the key distinction. This is a continuing education requirement, not a prerequisite. You don't need to complete it before selling variable life insurance for the first time. You complete it as part of your ongoing CE to maintain your license. However, California strongly encourages producers to complete the training before engaging in variable life sales, even though it's not legally required as a prerequisite. The 2-hour CE course must be approved by the California Department of Insurance specifically for variable life insurance training. General life insurance CE courses don't satisfy this requirement. The course must cover topics specific to variable products, separate account operations, investment risk disclosure, prospectus delivery requirements, suitability analysis for variable products, the interaction between insurance and securities regulations, and the unique features of variable life versus traditional permanent life insurance. Remember, to sell variable life insurance in California, you need 3 things. First, a California life insurance license. Second, FINRA securities registrations, typically Series 6 or Series 7, plus Series 63. Third, effective January 1st, 2025, completion of the 2-hour variable life CE course during each renewal period. All 3 are mandatory. You cannot sell variable life with just an insurance license, and starting in 2025, you cannot maintain your ability to sell variable life without the ongoing CE. Let's discuss why California implemented this ongoing CE requirement for variable products. Variable life insurance is among the most complex products in the market. It combines mortality risk, investment risk, tax considerations, securities regulations, and insurance regulations into one product. The landscape is constantly changing. New investment options emerge, regulations evolve, and market conditions shift. California recognized that producers selling these products need ongoing education to stay current. The 2-hour CE must specifically address variable life and variable universal life. It cannot be a general investments course or a general life insurance course. The content must focus on the unique aspects of variable insurance products. Topics typically include understanding separate account structures, explaining how death benefits and cash values fluctuate with market performance, disclosing all fees and charges associated with variable products, delivering prospectuses and understanding what they contain, and assessing suitability, determining when variable life is appropriate for a client's situation. The course should also cover common compliance issues specific to variable life sales. These include failing to deliver a prospectus before or at the time of sale, misrepresenting investment performance, comparing variable life to traditional investments without proper context, and selling variable products to conservative investors who cannot tolerate investment risk. California wants producers to understand not just product features, but also regulatory pitfalls. Here's an important exam point. The 2-hour variable life CE is in addition to the 3-hour ethics and anti-fraud CE requirement. So every renewal period, if you sell variable life, you need 2 hours of variable life CE plus 3 hours of ethics/anti-fraud CE plus 19 hours of general CE for a total of 24 hours. The variable life CE cannot be counted toward your ethics requirement or your general CE. It's a separate, specific mandate. Let me give you a timeline example for exam purposes. Say your license renewal date is March 31st, 2026. You sell variable universal life insurance. Between April 1st, 2024 and March 31st, 2026, you must complete 3 hours of ethics and anti-fraud CE, including 1 hour specifically on fraud, 2 hours of variable life CE, and 19 hours of general CE topics. That's 24 hours total. If you don't complete the 2-hour variable life CE, your license renewal will be deficient, even if you have 24 hours of other CE. the 2 hours must be specifically on variable life. Now, what if you stop selling variable life products? Do you still need the 2-hour CE? Technically, the requirement applies to producers who sell variable life or variable universal life. If you've decided you're no longer selling these products and won't in the future, you could argue the requirement doesn't apply. However, California's position is that once you've sold variable products, you should maintain your knowledge through ongoing CE in case you return to selling them later. The safest approach is to complete the 2-hour CE with each renewal if you've sold variable products at any point. The training must be from California-approved providers. When selecting a CE course, verify that it's approved for California Variable Life CE credit. Some courses may cover variable products, but not be specifically approved for this requirement. Check the course description and approval status before enrolling. Let's discuss non-resident producers. If you hold a non-resident California license and sell variable life to California residents, you must comply with California's CE requirements, including the 2-hour variable life CE. Your home state's CE doesn't automatically satisfy California's specific variable life requirement unless California has reciprocity that explicitly covers it. Most states do not have such reciprocity for specialized CE like variable life training, so non-residents typically must complete California's 2-hour course separately. Here's an exam scenario. A producer licensed in Nevada holds a non-resident California license. He sells variable universal life policies to California residents. Nevada doesn't have a specific variable life CE requirement. Does the producer need to complete California's 2-hour variable life CE? Yes. California's requirements apply to anyone selling to California residents under a California license, regardless of residency status. The producer must complete California's 2-hour variable life CE along with California's other CE requirements. One final point about these training requirements: California has made clear that completion is verified. When you renew your license, you must certify that you've completed all required education, including any specialized training like the 4-hour cash value course or the 2-hour variable life CE. The department conducts audits and can request proof of completion. Education providers report completions electronically to the department, so there's a record. Falsely certifying that you've completed required training when you haven't is a serious violation that can result in license suspension or revocation. Let's recap the critical information from this section. The 4-hour cash value life insurance training applies to producers licensed on or after January 1st, 2024, must be completed before soliciting cash value products, is a one-time requirement, and applies to both residents and non-residents. The 2-hour variable life CE applies to all producers selling variable life or variable universal life, is an ongoing requirement for every license renewal, must be completed as part of your 24-hour CE, and is in addition to the 3-hour ethics/anti-fraud requirement. These are brand new requirements for 2025, which makes them prime exam material. California is testing whether you understand who must complete these trainings, when they must be completed, and how they fit into the overall licensing and CE framework. Expect multiple questions about these requirements because they represent significant changes to California's regulatory landscape. In the next section, we'll cover California agent responsibilities and prohibited practices, including fiduciary duties, specific prohibited practices under California law, and privacy requirements including California Consumer Privacy Act implications. Welcome to this section on California agent responsibilities and prohibited practices. This section is about the rules that govern your conduct as a licensed insurance agent in California. Understanding these requirements isn't just about passing your exam, it's about protecting your license and serving your clients ethically. California has some of the strictest agent conduct rules in the nation, and violations can result in license suspension, fines, or even criminal prosecution. Let's explore what California expects from you. Fiduciary duties under California law. As a licensed insurance agent in California, You are a fiduciary. This is a legal term that means you hold a position of trust and must act in your client's best interest, not your own. Fiduciary duties are among the highest standards of care recognized by law, and California takes them very seriously. Let's start with trust account requirements. When you collect premiums, applications fees, or any money from clients, that money belongs to the client or the insurance company, not to you. You must keep client funds separate from your personal funds. This is called avoiding commingling, and it's an absolute requirement. California law requires that agents maintain a separate trust account or fiduciary account for client funds. This account must be clearly labeled as a trust or fiduciary account, and it must be used exclusively for client funds. You cannot deposit your personal money into this account, and you cannot use client funds for personal expenses, even temporarily. Here's what this looks like in practice. If you collect a $1,000 premium check from a client, you have two options. Option 1, immediately forward the check to the insurance company without depositing it. Option 2, deposit the check into your trust account and then promptly remit funds to the insurance company. What you cannot do is deposit the check into your personal checking account, pay your bills with it, and plan to make it up when your commission arrives. That's commingling and misappropriation, both serious violations. Trust account records must be meticulous. California requires that you maintain a ledger showing every deposit into the trust account, every disbursement from the account, and the purpose of each transaction. You must be able to account for every dollar at any time. The California Department of Insurance can audit your trust account records without notice, and if the records are incomplete or show evidence of commingling or misappropriation, your license is at serious risk. Now let's discuss prompt premium remittance in detail. We touched on this in Section 7, but let's expand because it's critical. California requires agents to remit premiums to insurers promptly. Promptly is typically defined as within 15 calendar days of receipt. Though your agency contract may require faster remittance, some insurers require same-day or next-day electronic transmission. The 15-day rule applies to premiums collected by the agent. If the client pays the premium directly to the insurer, the agent isn't involved in remittance. But if you collect the check or cash, the clock starts ticking immediately. Day 1 is the day you receive the funds. By day 15, those funds must be in the insurer's possession. Why is prompt remittance so important? Several reasons. First, the policy may not be in force until the insurer receives the premium. If you hold a premium for 30 days and the insured dies during that period, there could be a coverage dispute. Second, the client trusts you to handle their money properly. Delays suggest you might be using client funds for personal purposes. Third, California law requires it, and violations are grounds for license suspension. Here's an exam scenario. An agent collects a $500 monthly premium from a client on January 5th. The agent is busy and doesn't remit the premium until February 8th, 34 days later. During that time, the premium was sitting in the agent's personal checking account. How many violations has the agent committed? At least 3. First, commingling client funds with personal funds. Second, failing to remit within 15 days. Third, holding client funds in an account not designated as a trust account. This agent faces disciplinary action, potential fines, and possibly license suspension. Record-keeping requirements under California law are extensive. You must maintain records of all insurance transactions for at least 3 years. This includes copies of applications, policy delivery receipts, replacement notices, premium receipts, correspondence with clients and insurers, and records of all funds received and disbursed. California requires that records be organized and accessible. If the Department of Insurance requests records during an examination or investigation, you must be able to produce them quickly. "I'll have to look for that," or "I think I threw that away," are not acceptable responses. Failure to maintain required records is itself a violation, even if no other wrongdoing is found. Electronic records are acceptable, but they must be secure and backed up. If you maintain records electronically, you need a system that prevents unauthorized access, protects against data loss, and allows you to retrieve records when needed. Cloud-based customer relationship management systems are popular because they provide these features, but whatever system you use must meet California's requirements. One more fiduciary duty: disclosure. You must disclose material information to clients. If you have a financial interest in recommending a particular insurer or product, beyond your normal commission, you must disclose it. If you're aware of information that would affect the client's decision, you must share it. Withholding material information to induce a client to purchase a policy is a violation of your fiduciary duty. Prohibited practices under California Insurance Code. California law specifically prohibits certain practices that harm consumers or undermine the integrity of the insurance market. These prohibited practices are defined in the California Insurance Code, and violating them can result in license revocation, fines, restitution orders, and even criminal prosecution. Let's go through each one. First, twisting. Twisting is inducing a policyholder to lapse, forfeit, surrender, or replace insurance coverage through misrepresentation or incomplete comparison. The key element is misrepresentation. If you tell a client their existing policy is bad or outdated without providing factual, balanced information, that's twisting. If you exaggerate the benefits of a new policy while downplaying or concealing its drawbacks, that's twisting. Here's an example of twisting. An agent tells a client, "Your old policy is terrible. The insurance company is ripping you off. You need to cancel it immediately and buy this new policy." In reality, the old policy has guaranteed cash values, low policy loan rates, and accumulated dividends, while the new policy has higher fees and no guarantees. The agent is twisting, using misrepresentation to induce a replacement. Contrast that with a legitimate replacement. An agent says, "Let's compare your existing policy to this new one. Your existing policy has these features and costs. The new policy has these features and costs. Here are the pros and cons of each. Based on your current needs, here's my recommendation and why." That's proper disclosure and balanced comparison, not twisting. Next, churning. Churning is replacing insurance policies repeatedly to generate new commissions when the replacements are not in the client's best interest. Churning is a form of fraud because the agent is putting their financial interest ahead of the client's welfare. It's especially problematic with products that have surrender charges or that restart contestability periods. A classic churning scheme involves replacing whole life or universal life policies every few years. Each replacement generates a first-year commission for the agent, but the client pays surrender charges, loses accumulated cash value, and restarts contestability and suicide exclusion periods. After 3 or 4 replacements, the client has paid enormous premiums and has little to show for it, while the agent has collected multiple commissions. California prosecutors have brought criminal charges against agents for churning, particularly when it targets seniors or other vulnerable populations. Churning is not just a licensing violation, it's theft by fraud. If you're caught churning policies, you'll lose your license, face restitution orders, and potentially face felony charges. Now let's discuss misrepresentation and concealment. Misrepresentation is making false or misleading statements to induce someone to purchase insurance or to reject a claim. Concealment is intentionally withholding material information to achieve the same result. Both are prohibited. Examples of misrepresentation include telling a client a policy is fully paid up when premiums are still required, claiming a policy's cash value is guaranteed when it's based on non-guaranteed assumptions, stating a policy covers a particular risk when it's actually excluded, or misrepresenting the financial strength or rating of an insurance company. Concealment includes failing to disclose surrender charges, not mentioning that a policy has a 2-year suicide exclusion, hiding the fact that you'll earn a much higher commission on one product versus another, or failing to disclose material medical information when completing an application on behalf of a client. Here's an important point. Misrepresentation doesn't require intent to deceive. If you make a false statement because you didn't know better, that's still misrepresentation. Ignorance is not a defense. As a licensed agent, you're expected to know the products you sell and the representations you make. If you're unsure about a policy feature, you must verify it before making statements to clients. Next, rebating and inducements. California generally prohibits rebating, offering or giving anything of value not specified in the insurance policy as an inducement to purchase insurance. The prohibition exists to ensure that insurance is purchased based on coverage and price, not because the agent offered kickbacks or valuable gifts. What does this mean in practice? You cannot offer cash rebates. Buy this policy and I'll give you $500 cash. You cannot offer valuable gifts. Buy this policy and I'll give you a new iPad. You cannot offer services. Buy this policy and I'll mow your lawn for free for a year. All of these are rebates, and all are prohibited. However, California does allow some items of nominal value. You can provide promotional items like pens, calendars, coffee mugs, or notepads with your company logo, as long as they're of minimal value, typically under $25. You can take a client to lunch to discuss their insurance needs. You can provide educational materials or software tools that help clients understand insurance. The key is that these items must be of nominal value and not conditioned on purchasing a policy. California also has specific exceptions. You can offer discounts to members of groups, such as affinity discounts for professional associations or alumni groups, as long as the discount is offered to all members equally and is disclosed in the policy filing. You can participate in insurer-sponsored sales contests where prizes go to top-selling agents, as long as the prizes are paid by the insurer, not the agent, and don't reduce the client's premium. Rebating violations are taken seriously because they create unfair competition and can lead to consumers making purchasing decisions based on kickbacks rather than coverage needs. If you're caught rebating, you face fines, license suspension, and orders to repay all rebates to the insurer. Now let's discuss defamation and disparagement. Defamation is making false statements that harm another person's or company's reputation. Disparagement is making derogatory statements about a competitor's insurance products or business practices. Both are prohibited under California insurance law. You cannot say, ABC Insurance Company is going bankrupt, unless you have factual evidence to support the statement. You cannot say, that agent is a crook, even if you dislike your competitor. You cannot say, XYZ Company denies every claim, unless you can prove it's true. False statements that damage reputations are defamation. Disparagement is more subtle. It's making negative comments about competitors' products to steer clients toward your own. For example, their policy is junk compared to mine, or only an idiot would buy that policy. Even if there are legitimate differences between products, disparaging language crosses the line. The appropriate way to discuss competitors is factual and respectful. Their policy has these features and costs. My policy has these features and costs. Here's how they compare. Based on your needs, here's my recommendation. You can point out factual differences without disparaging the competition. Finally, unfair discrimination. California prohibits unfair discrimination in underwriting, rating, or claims handling. Unfair discrimination means treating people differently based on factors unrelated to risk, such as race, color, national origin, religion, sex, marital status, sexual orientation, gender identity, or disability. It's important to understand that all insurance involves discrimination, charging different premiums based on age, health, or other risk factors. That's not unfair discrimination. That's actuarially justified underwriting. Unfair discrimination is treating people differently based on impermissible factors. For example, charging different premiums for men and women of the same age and health status is permissible because actuarial data shows different mortality rates. But charging different premiums based on race, even if the applicants have identical risk profiles, is unfair discrimination and is illegal. Agents must ensure they offer insurance to all qualified applicants without bias. You cannot refuse to quote insurance to someone because of their ethnicity, religion, or sexual orientation. You cannot steer certain clients toward inferior products based on impermissible factors. You cannot provide better service to some clients than others based on their background. California enforces anti-discrimination laws vigorously, and violations result in severe penalties. Privacy and information security. Now let's turn to an area that's increasingly important: privacy and information security. As an insurance agent, you collect sensitive personal information from clients: social security numbers, medical history, financial information, and more. California law imposes strict requirements on how you must protect this information and what rights clients have regarding their data. The California Consumer Privacy Act, known as CCPA, is one of the strongest privacy laws in the United States. It grants California consumers significant rights over their personal information and imposes obligations on businesses that collect, use, or sell that information. While there's an exemption for information collected in the course of insurance transactions, agents must still understand CCPA's implications. Under CCPA, consumers have the right to know what personal information a business collects about them, the right to know whether their information is sold or disclosed to third parties, the right to opt out of the sale of their information, the right to request deletion of their information, and the right to equal service regardless of whether they exercise these privacy rights. For insurance agents, the most relevant aspect is information sharing. When you collect information from a client for an insurance application, that information is shared with the insurance company, potentially with reinsurers, and possibly with third-party service providers like underwriting laboratories or medical information bureaus. California law requires that you provide clients with a clear notice of these information-sharing practices. The notice must be provided at or before the time of collecting information, typically when the client completes an application. The notice must explain what information is collected, how it will be used, with whom it will be shared, and how the client can access or correct their information. The notice must be clear and conspicuous, not buried in fine print or written in legalese. Here's what this looks like in practice. When a client sits down to complete a life insurance application, you should provide them with a privacy notice. This might be a separate document or part of the application itself. The notice explains, "We collect personal information including your name, address, social security number, medical history, and financial information. We use this information to underwrite and administer your insurance policy. We share this information with our insurance company partners, reinsurers, medical underwriting services, and other service providers necessary to process your application. We do not sell your personal information to third parties for marketing purposes. You have the right to access and correct your information by contacting us." California also requires specific notice provisions related to information sharing with affiliates and third parties. If your agency shares client information with affiliated companies for marketing purposes, such as sharing life insurance client data with an affiliated investment advisory firm, you must provide notice and an opportunity to opt out. Clients have the right to say, "Don't share my information for marketing purposes," and you must honor that request. Information security is also critical. California law requires businesses to implement reasonable security procedures to protect personal information from unauthorized access, destruction, use, modification, or disclosure. For insurance agents, this means several things. First, secure your files. Paper files containing client information must be stored in locked cabinets. When transporting files, keep them secure. Don't leave them visible in your car. When disposing of files, shred them. Don't just throw them in the trash. Second, secure your electronic systems. Use strong passwords and change them regularly. Enable two-factor authentication on sensitive accounts. Use encryption for emails containing sensitive information. Keep your software updated with security patches. Use secure, password-protected Wi-Fi networks, not public Wi-Fi at coffee shops, when accessing client information. Third, train your staff. If you have employees or assistants, they must understand privacy and security requirements. They should know not to discuss client information in public places, not to leave files open on their desks, and not to use unsecured systems to access client data. California has data breach notification requirements. If your agency experiences a breach, meaning unauthorized persons gain access to client information, you must notify affected clients without unreasonable delay. The notice must explain what information was compromised, what you're doing to mitigate harm, and what clients can do to protect themselves. Failure to provide timely breach notification can result in significant penalties. Here's an exam scenario. An agent stores client applications on a laptop. The laptop is stolen from the agent's car. The laptop was not password protected or encrypted. Has the agent violated California law? Yes, in multiple ways. First, failing to implement reasonable security measures by not password protecting and encrypting the device. Second, leaving sensitive information visible and accessible in an unsecured location. Third, the agent must now notify all affected clients of the data breach. This agent faces potential fines, disciplinary action, and liability for any damages clients suffer as a result of the breach. Consumer rights under California privacy laws extend to requesting copies of their information. If a client asks to see what information you have about them, you must provide it within a reasonable time frame, typically 45 days. You cannot charge excessive fees for providing this information. You also cannot retaliate against clients who exercise their privacy rights by refusing to serve them or providing inferior service. One final privacy point. California law prohibits the use of pretext to obtain information. Pretexting is obtaining someone's personal information through false pretenses, such as posing as someone else or lying about why you need the information. Insurance agents must never use pretext. If you need information from a client, ask for it directly and honestly. If you need information from a third party, such as a medical provider, you must have proper authorization from the client. Let's recap the essential points. As a fiduciary, you must maintain trust accounts, remit premiums within 15 days, and keep detailed records for at least 3 years. California prohibits twisting, churning, misrepresentation, concealment, rebating, defamation, and unfair discrimination, all grounds for license revocation. Privacy laws require you to provide clear notices about information sharing, implement reasonable security measures, notify clients of data breaches, and honor consumer privacy rights. These rules exist to protect consumers and maintain the integrity of the insurance industry. On your exam, expect questions about fiduciary duties, definitions of prohibited practices, and scenarios testing whether you can identify violations. California doesn't just want you to know the rules, it wants you to understand why they exist and how to apply them in real-world situations. We've now covered 11 major sections of California-specific life insurance exam content. You've learned about the unique requirements that distinguish California from other states: the 60-day grace period, enhanced senior protections, strict replacement regulations, unclaimed property obligations, new training requirements, and comprehensive agent conduct rules. Mastering this California-specific content, combined with your knowledge of general life insurance principles, will position you to pass your exam and succeed as a licensed professional in California's insurance marketplace. Welcome to this section on California long-term care insurance regulations. While long-term care insurance is technically separate from life insurance, many agents sell both products, and if you're taking a combined life and health exam, you need to understand California's specific LTC requirements. California has some of the most comprehensive long-term care regulations in the nation, including mandatory training, a state partnership program, and extensive consumer protections. Let's explore what makes California unique in this area. California-specific LTC requirements. Long-term care insurance covers the costs of extended care services, nursing home care, assisted living, home health care, and adult daycare when someone cannot perform basic activities of daily living due to chronic illness, disability, or cognitive impairment. It's an important product for an aging population, and California regulates it carefully to prevent abusive sales practices and ensure consumers get the coverage they need. Let's start with the California Partnership for Long-Term Care Program. This is a collaboration between the state and private insurance companies designed to encourage people to purchase long-term care insurance while protecting their assets. Here's how it works. Normally, if you need long-term care and exhaust your insurance benefits, you must spend down your assets to qualify for Medi-Cal, California's Medicaid program. This means depleting your savings, selling investments, and potentially losing your home. The partnership program changes this. If you purchase a partnership-qualified long-term care insurance policy and later exhaust your benefits, you can apply for Medi-Cal without having to spend down an amount of assets equal to the benefits your policy paid out. For example, if your partnership policy pays $200,000 in benefits over several years, and you then need Medi-Cal coverage, you can protect $200,000 of your assets from Medi-Cal's spend-down requirements. This is called asset disregard. Partnership policies must meet specific requirements to qualify. They must be tax-qualified long-term care insurance policies under federal law. They must include inflation protection, either automatic compound inflation at 3% annually for purchasers under age 61, or some form of inflation protection for purchasers age 61 and older. They must cover home and community-based care, not just institutional care. And they must meet California's benefit trigger standards, requiring inability to perform at least 2 activities of daily living or substantial cognitive impairment. Partnership policies must also include certain consumer protections: a 30-day free look period, guaranteed renewable status, prohibition against post-claims underwriting, and clear disclosure of all limitations and exclusions. Insurance companies must obtain California Department of Insurance approval for their policies to be designated as partnership qualified. As an agent, you must clearly explain the partnership program's benefits to clients considering long-term care insurance. You must explain how asset disregard works, what happens if the client moves to another state, partnership benefits may not be reciprocal, and the limitations of the program. You cannot misrepresent the partnership program as a guarantee that Medi-Cal will cover all future costs, because the client must still meet Medi-Cal's income and other eligibility requirements. Now let's discuss California's 8-hour long-term care training requirement. This is one of the most important California-specific requirements you need to know. Before you can solicit long-term care insurance in California, you must complete an 8-hour training course approved by the California Department of Insurance. This is a one-time requirement, not a continuing education requirement, though we'll discuss ongoing CE in a moment. The 8-hour training must be completed before you engage in any activities to solicit long-term care insurance. Solicit means the same thing here as it did with cash value life insurance: presenting products, providing illustrations, discussing policy features with prospects, or recommending specific LTC policies. You cannot legally do any of these activities without first completing the 8-hour course. Who must complete this training? Any agent who wants to sell long-term care insurance in California, whether you're a resident or non-resident licensee. If you hold a California license and want to sell LTC policies to California residents, the 8-hour training is mandatory. There's no grandfathering, even if you've been licensed for 20 years. If you haven't sold LTC before, you need the training before you start. What does the 8-hour course cover? The curriculum includes the types of long-term care services and providers, the difference between long-term care insurance and other products like Medicare, Medicaid, and disability insurance, policy features including benefit triggers, elimination periods, benefit periods, and daily or monthly benefit amounts, underwriting and risk assessment for LTC insurance, the California Partnership Program in detail, suitability standards for long-term care insurance, and California-specific regulations and consumer protections. The training must be from a California Department of Insurance-approved provider. You'll receive a certificate of completion that proves you've satisfied the requirement. Keep this certificate in your records because the department may request proof during examinations or investigations. Here's an important exam point. The 8-hour LTC training is separate from your pre-licensing education and does not count toward your continuing education requirements. It's a specific, standalone prerequisite for LTC sales. So if someone asks on your exam whether the 8-hour LTC training counts toward your 24-hour CE requirement, the answer is no. It's separate. Now let's discuss ongoing CE requirements for LTC sales. In addition to the initial 8-hour training, California requires agents who sell long-term care insurance to complete 8 hours of long-term care continuing education every 2 years. This is an ongoing requirement that repeats with each license renewal cycle. So here's how it works. You complete the initial 8-hour training before selling your first LTC policy. That's your prerequisite. Then, during each subsequent 2-year renewal period, you must complete an additional 8 hours of LTCCE to maintain your ability to sell LTC insurance. This 8-hour ongoing CE is in addition to your regular 24-hour CE requirement. Let me break down the math for you. Say you sell both life insurance and long-term care insurance in California. Every 2 years, you need 24 hours of general CE, which includes 3 hours of ethics and anti-fraud. If you also sell variable life, you need an additional 2 hours of variable life CE. And if you sell long-term care insurance, you need an additional 8 hours of LTCCE. That's 24 plus 2 plus 8 equals 34 hours total every 2 years, if you sell all these products. The 8-hour ongoing LTCCE must cover current topics relevant to long-term care insurance. This includes updates to California regulations, changes in the partnership program, new product developments, evolving suitability standards, and emerging issues in long-term care delivery and financing. The content must be approved specifically for California LTCCE credit. Why does California require this ongoing training? Because long-term care insurance is complex and rapidly evolving. The population is aging, care delivery models are changing, costs are rising, and regulations are adapting. California wants to ensure that agents selling LTC insurance stay current on these developments and can provide accurate information to consumers. Here's an exam scenario. An agent completed the 8-hour LTC training in 2022 and sold several LTC policies that year. The agent's license renews in 2024. Between 2022 and 2024, the agent sold a few more LTC policies but did not complete any LTCCE because they thought the 8-hour training was a one-time requirement. Is the agent compliant? No. The agent should have completed 8 hours of LTCCE during the 2022 to 2024 renewal period to maintain eligibility to sell LTC insurance. Failing to complete required CE is a licensing violation. Now let's turn to consumer protections specific to California's long-term care insurance regulations. These protections are extensive and reflect California's concern about potential abuses in the LTC market, particularly sales to seniors. First, California requires a 30-day free look period for long-term care insurance policies. This is longer than the standard 10-day free look for most insurance products and gives consumers more time to review their decision. During the 30-day period, the policyholder can cancel for any reason and receive a full refund of all premiums paid. The 30-day period begins when the policy is delivered, not when it's issued. Second, California prohibits post-claims underwriting for long-term care insurance. Post-claims underwriting is the practice of accepting an application without thorough underwriting, collecting premiums for years, and then when a claim is filed, investigating the application to find reasons to deny the claim or rescind the policy. This practice is fundamentally unfair and is illegal in California. Instead, insurers must conduct thorough underwriting before issuing a policy. They must review the application, order medical records if necessary, and make an informed decision about whether to issue coverage and at what premium. Once the policy is issued, the insurer cannot later deny claims or rescind the policy based on information that was available at the time of application, but not reviewed. Third, California requires that long-term care insurance policies be guaranteed renewable. This means the insurer cannot cancel or refuse to renew your policy because you age, develop health problems, or file claims. As long as you pay your premiums, the policy remains in force. The only grounds for cancellation are non-payment of premiums or material misrepresentation in the application. However, guaranteed renewable does not mean premiums are locked in. Insurers can increase premiums, but only on a class-wide basis, meaning they must increase rates for all policyholders in a particular class, not just those who file claims or develop health issues. Premium increases must be approved by the California Insurance Commissioner, who reviews the insurer's actuarial justification and ensures the increase is reasonable. Fourth, California requires specific disclosures about inflation protection. Long-term care costs rise over time, often faster than general inflation. A policy that pays $150 per day today might be inadequate in 20 years, when costs could be $300 per day. Inflation protection increases your benefits over time to keep pace with rising costs. California requires agents to offer inflation protection to all applicants and to explain the importance of this feature. For applicants under age 76, agents must specifically offer automatic compound inflation protection and obtain a signed rejection if the applicant declines. The rejection form must acknowledge that the applicant understands their declining inflation protection and that their benefits may not keep up with future cost increases. Fifth, California has suitability requirements for long-term care insurance sales. Agents must make reasonable efforts to determine whether long-term care insurance is suitable for the applicant based on their financial situation, insurance needs, and ability to pay premiums over time. This is especially important for seniors on fixed incomes. California regulations identify certain circumstances where LTC insurance is likely unsuitable. These include applicants whose income is solely from Social Security or supplemental security income, applicants who are eligible for Medi-Cal, applicants whose only significant asset is their home, applicants who are currently receiving long-term care services, and applicants who cannot afford the premiums without adversely affecting their standard of living. If an agent sells LTC insurance to someone in one of these categories, the agent must document why they believe the sale is suitable despite the red flags. Without such documentation, the sale may be presumed unsuitable, and the agent could face disciplinary action. Sixth, California prohibits certain sales practices specific to long-term care insurance. You cannot use scare tactics to pressure people into buying, such as telling seniors they'll be a burden on their children without LTC insurance. You cannot misrepresent government programs, such as claiming Medicare covers long-term care when it generally doesn't, or that Medi-Cal won't cover long-term care when it does, under certain circumstances. You cannot sell duplicate or unnecessary coverage. If a client already has adequate long-term care coverage, you shouldn't sell them another policy just to earn a commission. You also cannot recommend replacing an existing LTC policy with a new one unless the replacement clearly benefits the consumer and you've documented the reasons. California also requires specific handling of lapses. Long-term care insurance premiums can become burdensome, especially as policyholders age and face income reductions. California requires insurers to provide at least a 60-day grace period for LTC policies, similar to life insurance. If a premium is missed, the insurer must notify the policyholder and any designated third party. Additionally, California requires insurers to offer contingent non-forfeiture benefits. If a policyholder cannot afford premium increases and must let their policy lapse, they may be entitled to a reduced paid-up benefit based on premiums paid. This prevents policyholders from paying premiums for years and then receiving nothing if they can no longer afford the policy. Finally, California requires insurers to provide annual rate stability reports to policyholders. These reports disclose whether the insurer has requested rate increases in the past year, the status of any pending rate increase requests, and the insurer's historical pattern of rate increases. This transparency helps consumers understand the long-term cost stability of their policies. Here's an exam scenario testing consumer protections. An agent meets with a 75-year-old woman whose only income is $1,800 per month in Social Security benefits. Her only asset is her home, which is fully paid. The agent sells her a long-term care policy with a $3,000 annual premium. Is this appropriate? Almost certainly not. The applicant's income is solely from Social Security, and a $3,000 annual premium represents about 17% of her income, which likely adversely affects her standard of living. This is a red flag for unsuitability. The agent should have either not made the sale or documented extraordinary circumstances justifying it. This agent faces potential disciplinary action for selling unsuitable coverage. Let's recap the key points. California's partnership program offers asset protection for policyholders who exhaust their benefits, with specific qualification requirements, including inflation protection and comprehensive coverage. Before selling LTC insurance, agents must complete an 8-hour training course, then complete 8 hours of LTCCE every 2 years to maintain their ability to sell these products. California's consumer protections include a 30-day free look period, prohibition of post-claims underwriting, guaranteed renewable policies, mandatory inflation protection offers, suitability standards that require assessment of financial ability to pay premiums, and prohibitions on scare tactics and misrepresentations about government programs. Long-term care insurance is a valuable product for many Californians, but it's also an area where vulnerable seniors can be taken advantage of if agents are unscrupulous or poorly trained. California's extensive regulations reflect the state's commitment to ensuring this product is sold appropriately to those who genuinely need it and can afford it. On your exam, if LTC questions appear, expect them to focus on the 8-hour training requirement, the ongoing 8-hour CE requirement, partnership program basics, the 30-day free look period, and suitability considerations. Remember that these LTC requirements are in addition to all other California life insurance requirements we've covered. They layer on top of your existing obligations. We've now completed 12 comprehensive sections covering California-specific life insurance and related product regulations. You've learned the unique requirements, timeframes, consumer protections, and agent obligations that distinguish California from other states. This California-specific knowledge, combined with your understanding of general insurance principles, provides the foundation you need to pass your state exam and practice successfully in California's insurance marketplace. Welcome to this final section on the exam logistics specific to California. We've covered all the California-specific content you need to know. Now, let's talk about the exam itself. Understanding the structure, policies, and logistics of the California Life Insurance exam will help you prepare effectively and know what to expect on test day. Let's walk through everything you need to know. Exam structure. The California Life-Only Insurance exam consists of 75 questions that you must complete within 105 minutes total time. However, here's an important distinction. You have 90 minutes of actual testing time to answer the questions. The additional 15 minutes is allocated for the tutorial at the beginning of the exam and a brief survey at the end. So, when you're timing yourself during practice, focus on the 90-minute testing window. That's your real constraint. 75 questions in 90 minutes means you have an average of 1.2 minutes per question. That's 72 seconds. Some questions you'll answer in 20 seconds. Others might take 2 or 3 minutes if they involve calculations or complex scenarios. The key is to pace yourself. Don't spend 5 minutes on one difficult question while easier questions go unanswered. The exam combines both national insurance content and California-specific content. There's not a separate section labeled California Questions. Instead, California-specific material is integrated throughout the exam. You might answer a general question about life insurance policy provisions, Then, the next question tests your knowledge of California's 60-day grace period. Then, the next question is about beneficiary designations, a mix of general and state-specific content. Approximately 25% to 35% of the exam focuses on California-specific laws, regulations, and requirements. That's roughly 19 to 26 questions out of 75. The rest covers general life insurance concepts that are tested nationwide: policy types, underwriting, taxation, retirement plans, and so on. This means you need to master both general life insurance knowledge and the California-specific material we've covered in this video. The passing score is 70%. To pass, you must answer at least 53 questions correctly out of 75. That means you can miss up to 22 questions and still pass. However, don't aim for 70%. Aim higher. The closer you are to the passing threshold, the more stressful the exam becomes. If you're consistently scoring 80% or higher on practice exams, you'll walk into the real exam with confidence. Here's something important. The exam does not tell you which questions are California-specific and which are general. You need to know the content well enough to recognize when California law applies versus when general principles apply. For example, if a question asks about grace periods without specifying term or permanent life insurance, you need to know that California requires 60 days for traditional life insurance, but 31 days for variable life insurance. Context matters. Now let's talk about exam fees. The California Department of Insurance charges an $88 examination fee. This is the state's fee for developing, administering, and scoring the exam. You pay this fee when you apply for your license through the department's online system or through NIPR or CIRCON. If you choose to take your exam at a PSI testing center, which offers more locations and flexible scheduling including evenings and weekends, there's an additional $43 convenience fee. So your total cost would be $88 plus $43, equaling $131. If you test at the Department of Insurance's own testing location in Los Angeles, you only pay the $88 fee without the PSI convenience fee. However, the department's location has more limited hours and fewer available appointments. You can also take the exam remotely through PSI's online proctoring service, which also carries the $43 convenience fee. Remote testing allows you to take the exam from home using your own computer, with a live proctor monitoring you via webcam. This option became popular during the pandemic and continues to be available. Total cost for remote testing is also $131, the $88 department fee plus the $43 PSI remote proctoring fee. The exam is computer-based, whether you test at a PSI center, at the department's location, or remotely. You'll see one question at a time on the screen with 4 answer choices labeled A, B, C, and D. You select your answer by clicking on it. You can mark questions for review and return to them later if time permits. The system tracks your time and alerts you when you have 10 minutes remaining. One more point about exam structure. There are no trick questions, but there are questions designed to test whether you truly understand the material versus just memorizing facts. For example, instead of asking, "What is California's grace period for life insurance?" they might present a scenario. A policyholder's premium was due January 15th, but wasn't paid. On March 10th, the insured dies. Is the death benefit payable? You need to know that California's 60-day grace period means the policy was still in force on March 10th. So yes, the benefit is payable minus the unpaid premium. Scenario-based questions require you to apply your knowledge, not just recall it. That's why understanding the concepts and the reasons behind California's requirements is more valuable than memorizing lists. When you understand why California requires a 60-day grace period to protect consumers from inadvertent lapses, you can answer questions about grace periods in any context. Retake policies. Now let's discuss California's retake policies, which are governed by California Insurance Code sections 1682 and 1676. These policies are strict, so pay attention. First, California allows a maximum of 10 attempts to pass any single exam type within a 12-month period. The 12-month period starts from the date of your first attempt. So if you take the life-only exam on February 1st, 2025, and fail, you have until January 31st, 2026, to pass within your 10 allowed attempts. Let's be clear about what this means. You can fail the exam 9 times and still have a 10th attempt within that year. But if you fail all 10 attempts, you're prohibited from taking that exam again for 12 months. This is a hard stop. California Insurance Code, Section 1682 is unambiguous. After your 10th failed attempt, you must wait an entire year before attempting again. Why does California impose this limit? To ensure that people who become licensed actually understand the material. If someone could take the exam 20 or 30 times, they might eventually pass by luck rather than knowledge. The 10-attempt limit encourages serious preparation and study. Here's the good news. If you pass on attempt number 8, for example, those previous 7 failures don't matter anymore. You've passed, and you can proceed with your license application. The attempts only matter if you reach the 10-attempt limit without passing. Now, California is relatively generous with retake timing. You can retake the exam 24 hours after a failed attempt. So if you fail on Monday at 10 a.m., you can schedule your next attempt for Tuesday at 10 a.m. or any time thereafter. Some states impose longer waiting periods, 7 days or even 30 days, but California allows next-day retakes. However, just because you can retake immediately doesn't mean you should. If you failed the exam, you need to identify why. Was it lack of knowledge in certain areas? Poor time management? Test anxiety? Take a few days to review weak areas, take more practice exams, and build your confidence before attempting again. Retaking immediately without additional study usually just results in another failure and wastes one of your 10 attempts. Here's an important exam validity point. Once you pass the exam, your passing score is valid for 1 year to complete your license application. This is specified in California Insurance Code, Section 1676A. The 1-year period runs from your exam pass date. You must submit your license application, complete fingerprinting, and meet all other requirements within that year. Why does this matter? Because if you pass the exam but don't complete your license application within 1 year, your exam pass becomes invalid. You'd have to retake and pass the exam again to proceed with licensing. California wants to ensure that people who become licensed have current knowledge, not exam passes from years ago. Let's walk through a timeline example. You pass the life-only exam on March 15, 2025. Your exam pass is valid until March 14, 2026. During that year, you must submit your license application, complete fingerprinting through live scan, and satisfy any other requirements. If you complete everything by March 10, 2026, you're fine. Your license will be issued. But if you delay and don't submit your application until April 2026, your exam pass has expired, and you'll need to retake the exam. Here's a common question. If you pass the exam and get licensed, but then your license lapses years later because you didn't renew, do you have to retake the exam? It depends. If your license has been expired for less than 12 months, you may be able to reinstate it by paying late fees and completing any required continuing education. But if your license has been expired for more than 12 months, California typically requires you to start over, retake the pre-licensing education, retake the exam, and reapply as a new applicant. This is why it's critical to renew your license on time. Another scenario, what if you pass the life-only exam and then decide you also want to get licensed for accident and health? You'd take a separate exam for accident and health. Your life-only exam pass doesn't expire just because you're pursuing additional licenses. Each exam type is independent. The 10-attempt limit applies separately to each exam type. So you could have 10 attempts at the life-only exam and separately have 10 attempts at the accident and health exam. They're tracked individually. not combined. Here's a crucial point for exam day. If you fail, the testing center will provide you with a diagnostic report showing which content areas you struggled with. This report doesn't tell you which specific questions you missed. The exam questions are confidential, but it shows your performance by subject area. For example, it might show you scored 60% on California regulations, 75% on life insurance policies, and 80% on taxation. Use this diagnostic report to focus your studying before retaking the exam. Don't just study everything again. Concentrate on your weak areas. Language options. California is one of the few states that offers insurance licensing exams in multiple languages, and this is a significant development that began in 2024. As of July 1, 2024, California's life insurance exam is available in English, Spanish, Korean, Simplified Chinese, Vietnamese, and Tagalog. This expansion makes licensing more accessible to California's diverse population. Here's what you need to know. Regardless of which language you choose, the exam content is identical. The same 75 questions, the same 90 minutes of testing time, the same 70% passing score, and the same legal requirements. The only difference is the language in which the questions and answers are presented. You select your preferred language when you schedule your exam through PSI. If you're more comfortable taking the exam in Spanish, Korean, Simplified Chinese, Vietnamese, or Tagalog, those options are available. The exam has been professionally translated and reviewed for accuracy to ensure that non-English versions are equivalent to the English version. One important note: while the exam is available in multiple languages, all licensing documents, applications, and correspondence with the California Department of Insurance are typically in English. So even if you take the exam in Spanish, for example, you'll need to complete your license application and other paperwork in English, or arrange for translation assistance. Additionally, when you work with clients, you'll need to ensure they understand the insurance products you're selling. If you work primarily with Spanish-speaking clients, for example, California encourages you to provide documents and explanations in Spanish when possible. Some insurers provide policy documents and marketing materials in multiple languages for this purpose. Here's an exam strategy tip. If English is your second language, you might wonder whether to take the exam in English or your native language. Consider this. Insurance terminology in English is standard across the industry. Terms like whole life, universal life, beneficiary, and underwriting are used consistently. If you've studied using English materials, taking the exam in English might actually be easier because you're familiar with the terminology. However, if technical English is challenging for you and you're more comfortable reading and comprehending in another language, the translated exam is a valuable option. The availability of multilingual exams also applies to the prelicensing education materials. California requires education providers to offer the 12-hour Ethics in California Insurance Code course in the same languages as the exams: Spanish, Korean, Simplified Chinese, Vietnamese, and Tagalog, in addition to English. This ensures that language is not a barrier to entering the insurance profession in California. One final logistics point. On exam day, whether you're testing at a PSI center, at the department's location, or remotely, you'll need to bring valid identification. Acceptable IDs include a driver's license, passport, or other government-issued photo ID. The name on your ID must match the name on your exam registration. You cannot bring notes, books, phones, or any other materials into the testing room. The testing center provides scratch paper and a pen or pencil if you need to do calculations. For remote testing, you'll need a quiet, private space with a reliable internet connection, a computer with a webcam and microphone, and a clear workspace with nothing on it except your computer. The online proctor will ask you to show your ID to the camera and pan the camera around your room to ensure there are no unauthorized materials present. Remote testing is convenient, but it requires strict adherence to proctoring rules. Let's recap the essential information. The life-only exam has 75 questions to complete in 90 minutes of testing time, with California-specific content integrated throughout. You need 70% to pass, which is 53 correct answers. Exam fees are $88 for the department, plus $43 if testing at PSY or remotely, totaling $131. You have up to 10 attempts within 12 months to pass. After a failed attempt, you can retake after 24 hours. After 10 failures, you face a 12-month ban. Once you pass, your exam is valid for 1 year to complete your license application. The exam is available in 6 languages: English, Spanish, Korean, Simplified Chinese, Vietnamese, and Tagalog, with identical content and requirements. Understanding these logistics helps you plan your preparation and reduces anxiety on test day. You know what to expect, how the exam is structured, what your options are if you don't pass on the first try, and how much time you have to complete your licensing after passing. You've now completed the California-specific life insurance exam content. From the California Insurance Code and ethics requirements, to policy provisions with that critical 60-day grace period, through replacement regulations, claims settlement practices, marketplace regulations, premium and lapse requirements, variable life rules, unclaimed property obligations, new 2025 training requirements, agent responsibilities and prohibited practices, long-term care regulations, and finally, the exam logistics themselves. This comprehensive California-specific knowledge, combined with your study of general life insurance principles, positions you to walk into that exam room with confidence. You understand not just what California requires, but why these requirements exist: to protect consumers, ensure agent competence, and maintain a fair, ethical insurance marketplace. As you prepare for your exam, focus on the numbers that are unique to California. 60-day grace period for traditional life, 31 days for variable life, 30-day free look for replacements, and seniors age 60 plus, 10-day standard free look, 15-day premium remittance, 15-day claims acknowledgment, 90-day Death Master file response timeline, 8-hour LTC training, 4-hour cash value training for newly licensed producers, 2-hour variable life CE, 24-hour total CE with 3 hours ethics including 1 hour anti-fraud, and 70% to pass with 75 questions in 90 minutes. Master these California distinctions, understand the consumer protections behind them, and you'll be ready to pass your exam and begin your career as a licensed life insurance professional in California. Please note that this video lesson focuses only on California-specific life insurance laws, regulations, and requirements that differ from general or national content. Test takers should review these California topics alongside the broader life insurance concepts covered in national exam materials. As you prepare, remember the key distinctions that set California apart. The state allows a 60-day grace period instead of the typical 30 or 31 days seen elsewhere. There is also a 30-day free look period for replacements and for senior clients, reflecting the state's commitment to consumer protection. California provides enhanced safeguards for seniors, especially those aged 60 and older, with additional protections beginning at age 65. New 2025 training requirements are in effect, including a 4-hour course on cash value policies and a 2-hour course on variable products. Agents must also observe stricter notification and disclosure timeframes and comply with a 15-day standard for handling claims. Understanding these California-specific rules, alongside general principles of life insurance, will ensure you're fully prepared for the state licensing exam and confident in your professional knowledge. If you found this video helpful, be sure to give this video a like and subscribe for more life insurance exam prep videos.